This lesson we learn everything about every transaction has two aspects: double entry bookkeeping records both aspects of their accounts. The golden rule, meaning of terms debit and credit, completing entries, recording cash transactions in ledger accounts. Altogether, we discuss and practice questions based on these concepts. Double entry bookkeeping. Double entry bookkeeping is a system of recording transactions that means that there are two sides or aspects to every transaction. It is probably the most important thing to remember that every transaction is recorded twice in the books of account. The two entries to record the two aspects are made in ledger account. A ledger and ledger account. The two entries to record two aspects are made in ledger accounts. Transactions are recorded in ledger accounts. A ledger is a book that contains ledger accounts. Account. Transactions are recorded in ledger accounts. An account is a history of all transactions with similar nature. An account separates what is received from what is given, specifically in the cash account and bank account. An account has a left side known as debit side and right side known as credit side. Cash account. The cash account records cash received and cash paid. The left hand side of the account is called the debit side and is used to record cash received that is coming into the account. The right side of the account is called the credit side and is used to record the cash flow that is going out of the account. Business point of view. Bookkeeping or accounting treats business as persons with separate entities from their own. Therefore, all transactions are recorded from the point of view of business, not from those of its customers and suppliers. Date every entry and enter the name of another account in which that entry is counted. Postings. Entries in ledger accounts are known as postings. Bookkeepers are said to post transactions to the account. Always remember to keep track of the debit and credit postings and include the correct wordings and currency sign. Golden rule. The most important thing is to remember the golden rule. For every debit entry in one account, there must be an equal credit entry in another account. Double entry bookkeeping credit transactions. In this lesson, we learn everything about recording transactions involving lateral payments, credit transaction versus credit account, how to record credit transaction in payment, discounts, trade versus cash, meaning and concept, cash system versus accrual system, completing entries. Altogether, we discuss and practice questions based on these concepts. Credit transactions. Many transactions take place without any being paid or received at the time. No entries to record payment or receipt is made until money is paid or received. Credit sale and accounts receivable. Remember to record all transactions from the point of view of the business, not from those of its customers. In a seller's book, a sale of credit is credit to sales account and debited to an account opened in the customer. In accounting, someone who owes the money, business money, is known as a debtor. When the customer or a top place, their account is created, their bank account debited.
Hello?
Someone to whom the business owes money is known as a creditor. When the supplier is paid, their account is debited and the bank account paid. Trade discount. Trade discount is an allowance made by one trader to another. It is attention to the selling price of goods made by one trader. Discount is only given where the buyer and seller are in the same line. Transactions are recorded only at the reduced prices as the net amount after discount. Trade discount is never recorded in ledger amounts. Cash or settlement discount. Cash and settlement discount is allowance for prompt payment. That is, if someone makes the payment before the stipulated time, the allowance is made to encourage such payments. Cash discount can be allowed or received. Cash discounts are
always कल शाम को ने अफजल फोन करे थे हमें पूरे जने में इसका नहीं क्या कि फैसला करती हूँ उनको
on the credit side of the purchase.
गई
Sales returns always go to a sales return account. They are never entered on the debit side of the sales account.
क्या परसों अचानक होता खुद को ये बारिश में भिगले को होता खुद को 9:30-10 घंटे हमको उसे कहता बोले तब समझ में नहीं आता जाने से नको हम ऐसा घरांगो हमारे तब उनको बोले तो कहता बोले तब सुनती नहीं नाम हमें अయ్యో उन्हें है भी वही सिमी उसे क्या करना होता हमें उन्हें अम्मा बेटे उन्हें क्या तब कर लेना सोटा लेना क्या फैसला करती है उन्हें क्या उनका जाता है उन्हें बुला दो उन्हें चला रहा उन्हें क्या इज्जत दे डालता उन्हें भाई मामों घर को किसी भी इज्जत देता नहीं अभी इज्जत गिरा लेती हूँ होता छोटा सा क्या है कि बा क्या तब कर लेना
Accounting assumptions, principles, conventions, and concepts. In this lesson, we learn everything about GAAP, generally accepted accounting principles, the most important rules, duality, the magic, business entity, realization, materiality, matching principle, prudence, money measurement, historic cost, consistency, going concern, substance over form. Identify and altogether we discuss and practice questions based on these concepts from exams. Accounting principles. Accounting principles are sometimes referred to as concepts and conventions. A concept is a rule which sets down how the financial activities of business are recorded. A convention is an acceptable method by which the rule is applied to a given situation. Business entity. The business entity principle is also known as the accounting entity principle. This means that the business is treated as being completely separate from the owners of the business. The personal assets of the owner, the personal spending of the owner, etc. do not appear in the accounting records of the business. The accounting records relate only to the business and record the assets of the business, the liabilities of the business, the money spent by the business, and so on. Everything is recorded from the viewpoint of business. If there is a transaction concerning both the business and its owner, then it is recorded in the accounting records of the business. When the owner introduces capital into the business, it is credited to the capital account to show the funds coming from the owner. The capital account shows a credit balance representing the amount owed by the business to the owner. When the owner makes drawings from the business, a debit entry will be made in the drawings account to show the value owing to the owner, which reduces the amount owed by the business to the owner. Consistency. There are some areas of accounting where the choice of method is available. For example, there are several different ways to calculate the depreciation of a non-current asset. Where a choice of method is available, the one with the most realistic outcome should be selected. Once a method has been selected, the method must be used consistently from one accounting period to the next. This is known as consistency principle. If this is not done, a comparison of the financial result from year to year is impossible and the profit of a particular year can be distorted. There may be good reason why it is necessary to change the method or valuation. In such a situation, the change may be made, but the effects of this should be noted in the financial statement. Duality. The principle of duality is also referred to as the dual aspect principle. Every transaction has two aspects, a giving and a receiving. The term double entry is used to describe how these two aspects of a transaction are recorded in the going concern. The accounting records of a business are always maintained on the basis of assumed continuity. This means that it is assumed that the business will continue to operate for an indefinite period of time and that there is no intention to close down the business or reduce the size of the business by any significant amount. This is the going concern principle. This continuity means that the non-current assets shown in the statement of financial position will appear at their value, which is the original cost less depreciation, and inventory will appear at the lower of cost of material. If it is expected the business will cease to operate in the near future, the asset value in the statement of financial position will be reduced. Assets will be shown at the expected sales value, which are more meaningful than the value in this situation. Historic cost. The historic cost requires that all assets and expenses are initially recorded in the ledger account of their actual cost. It is closely linked to the money measurement principle. Cost is a known fact and can be verified. Applying this principle makes it difficult to make comparisons about transactions occurring at different times because of the effect of inflation. Sometimes it is necessary to adopt a more prudent approach to ensure that the non-current assets are shown at a more realistic value. So the cost price is reduced by depreciation. Matching. The matching principle is also referred to as the accrual principle. This is an extension of the realization principle to include other income and expenses. The revenue of the accounting period is matched against the cost of the same period, the timing of the actual receipts and payments. The figure shown in income statement must relate to the period of time covered by the statement, whether or not money has changed hands. This means that a more meaningful comparison can be made of profit, sales, expenses, and so on from year to year. Materiality. The materiality principle applies to items of very low value, items which are not material, which are not worth recording as separate items. Other principles can be ignored as example of knowledge in recording such low value items for outlay and benefit to the gain from the strict application of it. For example, if I have a calculator purchased for office use is strictly a non-current asset, part of its value being lost each year through normal usage. The cost of calculating this and recording this each year would amount to more than the cost of the asset itself. Instead of the calculator being recorded as a non-current asset, it would be regarded as an office expense in the year of purchase. What is material for one business may not be so for another business. A laptop computer may be regarded as material for a large multinational business, but would be material for a small scale firm. A large business may decide that non-current assets consist less than 1,000 will be regarded as immaterial and be charged as interest. Small business may have much a lower figure. This principle is also applied by entering small expenses in expenses. Rather than having individual ledger accounts for office expenses like the light bills, flower displays, and so on. Materiality is also applied in relation to inventories of office supplies like chemicals and the total cost of inventory is treated as inventory, even though there are some left at the inventory. Money measurement. The money measurement principle means that only information which can be expressed in terms of money can be recorded in the accounting records. Money is a recognized unit of measure and is traditionally accounting transaction. It does not rely on personal achievement. There are many aspects of business which cannot be measured in terms of money, therefore do not appear in the accounting records. The moral of the workforce, the effectiveness of a good manager, the benefits of staff, training course all play an important in the decision of the business, but they will not appear in the accounting records. Their value cannot be expressed in monetary terms. In a similar way, launch of rival product or increased competition cannot be recorded in the accounting records. The prudence principle is also known as the principle of conservatism. This principle ensures that the accounting records present a realistic picture of the position of the business. However, the exercise of prudence does not allow the deliberate statement of assets or income or the deliberate overstatement of liabilities or expenses. In short, prudence does not permit bias. Accountants should ensure that the profits and extra assets are not overstated and the liabilities are not understated. The phrase Never anticipate a profit, but profit for all probable losses often used to describe the principle of prudence. Profit should only be recognized when it is reasonably certain that such a profit has been realized and possible losses should be provided. Prudence is a very important principle. If a situation arises where applying another accounting principle is contrary to the principle of prudence is applied. For example, under the realization principle, profit is earned when goods actually change hands. But if the customer fails to pay after a reasonable time, the principle of prudence may be applied and the debt is determined. Realization. The realization principle emphasizes the importance of not recording the profit until it has been actually earned. This means that the revenue is only regarded as being earned when the legal title to goods or services passes from the seller to the buyer, who has then obligation liability to pay for those goods. When an order is placed by a customer, no goods change hand and no profit is earned. Profit is regarded as being realized when the goods actually change hand. This is the same even if the goods are sold and the customer does not pay for them immediately. Substance over form. These words are used to describe the accounting treatment of something does not reflect the legal position. For example, a machine bought on hire purchase remains the property of the seller until the final installment has been paid. If the purchaser fails to pay the installment has become due, the seller may reclaim the machine. This is the legal position of the firm. However, the machine is being used in purchases the same day as the other machines that have not been bought on hire purchase. From an accounting point of view and for all practical purposes, the machine is no different from the other machine. This is the substance of the matter. The practical view is preferred to the legal view in the accounting treatment. This is known as substance over form. Balancing accounts. This lesson will learn everything about how to find and record a balance on a ledger account, what debit balances means, what credit balance means, discount column value. Practice less just 1 year. Why accounts need to be balanced? At some point during the training period, all the accounts in existence must be balanced. The cash book is balanced periodically to determine how much money is left in the bank account or how much cash the business is left. Similarly, the ledger accounts are balanced to determine how much the business owes other people, how much it is owed, and how much has been received from or spent or earned from the various activities. Why, how to balance an account? Add each side of the account to find which has the lesser value. Insert on that side the amount needed to make both sides equal or in other words balance. Insert the total on each side of the account and carry the balance down to the other side of the account on the next day. Balance C bar D and balance and B bar D. The balances carried down on account should always be shown as brought down on the accounts on the next day. The dates are important and included. One should always indicate a balance carried down C bar D or brought down B bar D. In most cases, balance C bar D and balance B bar D is acceptable. However, do not just write only C bar D and B bar D. When more accounts balance, the cash book will usually balance at frequent reports because it is always important to know how much money is in the bank account. Accounts of customers and suppliers are balanced monthly because of the practice of settling and receiving statements of account. The statement of accounts are copies of the statements of customers of the sellers' books and are sent to customers so that they can reconcile their ledger accounts with those of their suppliers. Any difference can be inquired into an agreement reached between supplier and customer. The statements also remind customers that payment of outstanding balances. The other accounts are balanced as and when required. This will always be when a trial balance is. The classification of accounts and division of the ledger. In this lesson, we learn everything about the accounts are either personal or impersonal. The impersonal are either real or not. Ledger contains the transactions of the simple nature. Altogether, we discuss and practice questions based on this. The classification of accounts. All accounts fall into one of two classes: personal account or impersonal account. Each of these classes can be further divided into subgroups. Personal accounts. Account for trade receivables. A customer who owns the business money is known as a debtor. Their accounts have debit balances. When all the debit balances for all customers are added together, the total is referred to as trade receivables. Accounts for trade credits. Persons to whom the business owes the money is known as a creditor. Their accounts have trade balances. When all the trade balances for all the suppliers are added together, the total is referred to as trade credits. The owner's capital and drawings accounts. Impersonal accounts. All accounts other than personal accounts. Asset accounts. Real accounts are the things that the business owns. It is important to say that asset is both something owned by the business or owed to the business. Remember to state both aspects of owned and owned. Assets accounts are further divided into non-current assets and current assets. Non-current assets are things that are acquired for use in the business and not for resale. These assets are intended to be used in business for a number of years. Expenditure on non-current assets is capital expenditure. This includes such things as building machinery. Current assets arise in the course of trading such as inventories, cash and bank balances. Impersonal accounts, nominal accounts, expense accounts, which are things such as rent payable, wages, salaries, heating and lighting, postage and stationery. This type of expenditure is revenue expenditure expense. The costs incurred in running a business on a day-to-day basis. Accounts have a debit balance. Revenue accounts are accounts with credit balances. These accounts record the revenue of the business such as sales and other income such as rent receivable, discounts received and interest received. Caution. Capital expenditure versus revenue expenditure. The distinction between types of accounts is very important. Care must be taken to ensure that capital expenditure is not confused with revenue. The cost of purchasing a motor vehicle is capital expenditure and is debited to motor vehicle account. The cost of running the motor vehicle is revenue expenditure and motor vehicle revenue. As a result, you will always find capital expenditure on the statement of financial expenditure. Revenue expenditure, on the other hand, is always found in the income statement of finance. Division of the ledger or categorization of the ledger. Except in very small businesses, there are too many accounts to difference in the ledger. It is usual to divide the accounts among several ledgers as follows: sales ledger for accounts of customers, purchase ledger for accounts of suppliers, general or nominal ledger for investment accounts for assets, revenue or income expenses. Private ledger for accounts of confidential nature such as bonus, capital, financial statements. Cash book containing cash and cash accounts, cash and bank accounts, petty cash output for minor items. Need for division of ledger. The division of ledger, as discussed, is essentially a business which employs several bookkeepers. The work may be divided between them so that they do not all need to be working on the same ledger at the same time. It makes sense to group items of similar nature. This allows staff to be trained in different aspects of the business. Perhaps most importantly, it helps to detect and prevent errors occurring in the books of account. It may also help to detect the prevent fraud by account staff. This is known as internal control. The trial balance. In this lesson, we learn everything about what is the trial balance, the purpose of trial balance, how to prepare a trial balance, limitations of trial balance, the agreement of the two sides of the trial balance. Altogether, we discuss and practice questions based on these concepts. The trial balance. It is important to remember that the trial balance is not a part of the double entry system. It is simply a list of balance. If the ledger accounts are balanced monthly, then a trial balance can also be drawn on the basis of this. Trial balance should be added to the term trial balance along with the data. It is important to remember that trial balance is not a part of the voluntary system, as it is simply a list of balances. The ledger accounts are balanced monthly, then a trial balance can also be drawn on the trial balance. The trial balance should be added with the term trial balance along with the date and certificate. How to prepare a trial balance? First, balance all the ledger accounts in the trial. Then list the accounts with the debit balance and the credit balance. The total of the visible balances should equal to the total of credit balances. If the totals are equal, the trial balance is. What to do in trial balance based problem? Check the addition to the trial balance. If the difference in trial balance is divisible, look for a balance equal to half the difference in trial balance. If the difference is divisible, balance two figures can have been transferred into balance. Example 256 is taken as 556. If you have still haven't found the cause of the balance, then go back to the start and check the balances and check the amount that you have transferred for this particular balance. format of trial balance. This is the format of trial balance where you will have details for your debit and credit columns. The purpose of the trial balance can help in locating mathematical errors. However, the balance of trial balance will not prove that the entries in the ledger account are exactly the same. The trial balance is useful in different financials. Trial balance and errors. The trial balance and errors. If the trial balance fails to balance, when a trial balance fails to balance, it is obvious that an error has been made somewhere. This may be an error of addition within the trial balance, an error of addition within the ledger account. Entering a different figure on the credit figure entered on the debit figure, making a double entry figure, making a single entry per transaction rather than encoding a transaction twice in a single figure. Balance trial balance. Limitations of the trial balance. In trial balance is the total of the debit transactions. It does not imply that the double entry is error. The trial balance will start the still balance with one of the following errors. Error of commission. Error of commission. This occurs when a transaction is entered using the correct amount and the correct but in the wrong amount of the same class. Cash receipt Malik credit to Malika's. Error of complete reversal. This occurs when the correct amount is entered in the correct account but the entry has been made on the wrong side of the cash flow shifted to cash income credited to the balance. Error of commission. This occurs when a transaction has been completely omitted from the account. Either a debit entry or a credit entry. Payment of credit is not a credit. Error of original entry. This occurs when an incorrect figure is used when the transaction is presented in the account. The double entry will therefore equal to the incorrect figure. Goods $100 bought on credit but reversed for $1. Error of principal. This occurs when a transaction is entered into the correct account and the result is the wrong class. Compensating errors. This occurs when two or more errors cancel each other. Purchase account and added by $. Sales items Statements of financial position for sole traders. Statements of financial position for sole traders. In this lesson, we learn everything about what a statement of financial position is. It is the account of financial position, right? It is the preparation of statements of trial balance, the transfer, the concept of transfer entries in this case, five sections: first assets, then liabilities and capital defined items. Special items considered, the rule of the pattern for sole traders. Altogether, we discuss and practice questions based on format of statement of financial position. So it will have non-current assets, that will be total assets, Then capital and liabilities. That will be non-current liabilities, current liabilities. So that will be total liabilities. So total assets will be equal to total liabilities. Statement of financial position. Learn in part. It's very important. So that's why you learn in parts, 5 parts. First you learn part 1, that is non-current assets. So non-current assets, first you have to display the intangible assets like goodwill and all. So then you have to show the other assets like premises, office furniture. So again you have to display the cost, recognized depreciation. So that is for non-current assets. Current assets. Current assets we have to display cash and cash. Capital and liabilities. And the capital and liabilities, first you have to show capital. Capital start with opening balance, then add profit, then take capital to closing capital. Non-current liabilities and current liabilities. Non-current liabilities are like loans taken payable after a longer period, and current liabilities trade payable. So total liabilities, that will be total. Statement of financial position. Statement of financial position shows the assets the assets show how the resources are used and the liabilities show where. Statement of financial position. The trading a statement of financial position can provide a good indication of the answer to this question. Unlike an income statement, the statement of financial position is not part of the double entry model. After the nominal account balances have been transferred to the income statement, the only balances left in the ledger are those for assets and liabilities. The statement of financial position is financial statements of business. Also, a statement of financial position is not an account. The income statement and statement of financial position are not collectively as a financial statement of business. This may include the statement of cash flow. 5 important terms using statement of financial position. Non-current assets. These are items which are purchased to use in the business for a longer period of time, certainly longer than 12 months period. They include such things as land and building. Current assets. These are things which arise in the normal course of business, including cash and bank. Current liabilities include here are trade payables and bank payables. Non-current liabilities. These are items which are business has to pay at a date more than 12 months after the date of payment. Capital is the owner's interest. Non-current assets. These are grouped altogether and total. Tangible assets is patents, trademarks, tangible assets. The assets which are likely to have the longest useful life are placed for this is referred to in the order of permanence. Example, land and current assets. These are grouped next and total. The order in the statement of closing cash is the total of the debit balances. This is the total of debit balances of the bank. The order is sometimes referred to as the order of liquidity, and current assets are the important liquid assets. Liquid asset is one which is the form of cash or securities to a bank. Inventory is not liquid asset because it has not been sold and no money has been or will be received for until it is sold. Trade receivable should soon become a liquid asset and capital. Capital is shown in the trial balance, the balance and capital account. Added to this is the profit formation. Loss for the year must be deducted. Profit increases capital and losses. The owner's drawings are then deducted. This is the closing balance for the capital account. Carried forward non-current liabilities. These are liabilities or debts which are not due to supervision and of the reserve balance. Example, bank loans is of 2 years. Current liabilities. These are liabilities or debts which are due to supervision of the date of state financial. Example, bank loans is not of components of financial statement. Assets. Assets are divided into three. There are non-current assets. There are two types of non-current assets: tangible and non-current assets. Tangible non-current assets. Tangible non-current assets. Tangible non-current assets are long-term which are often produced rather than a statement of financial position is used for the business to be arranged in increasing or decreasing order of liquidity. This means the most of the assets are shown for a typical order of tangible non-current assets and intangible non-current assets. Intangible non-current assets are long-term assets which cannot be seen in us. However, they belong to the business. We have example of intangible non-current assets goodwill, brand, etc. In a statement of financial position, intangible non-current assets are shown the company current. Current assets are short-term assets because they arise from the non-income activity. These are assets which are either cash or I can turn into cash examples of current assets including trade receivables and cash. In a statement of financial position, it is needed for this means that the assets further stemming from the cash assets in order for the current assets in the statement of is inventory, trade receivables, and cash. Components of financial statement. Liabilities. Liabilities are divided into three types: capital, non-current liabilities, current liabilities. Capital represents the owner's investment in the business and is the output of the business. Non-current liabilities are among the business which are not used for current liabilities are short-term liabilities. Current liabilities are current assets are there among the there are among both the business which are due for repayment within the next 12 months. Examples of current liabilities, trade credits and bonds. Suspense accounts. How to start and finish studying. Have a bird's eye view of the entire syllabus. Study each topic. Work out examples, illustrations, and exercises. Repeat until you understand. Practice exam questions. Practice mock exams. Simulate exam conditions and practice. In this lesson, we learn everything about how to, the purpose of suspense account and how to prepare them, how to prepare unit test to record errors, to correct errors, how to revise the problem for the year for draft of how to revise the working capital in drafts of financial position. Altogether, we discuss and practice questions based on this concept. Identify and practice examination problems. The journal is a book of finance used to record the transaction and not recorded any book of finance. The journal is not part of the voluntary. The other is diary transaction before they are entered in the ledger. Anything which is not entered in the ledger being recorded in the ledger. Opening journal entries. Purchase and sale of non-current assets. Non-regular transactions. Correction of errors. Errors made in recording of the day-to-day transactions can be divided into those which are not shown by trial and those which result in the transaction not valid. Errors which are not shown by trial. These are the 6 types of errors which can be made which will not be revealed in the trial. These are error of committing towards the error of error of When such errors are discovered, they should be corrected by means of geometry before making entries in the appropriate ledger. Errors which affected trial balance. Some errors may occur that result in a total of the trial balance not found. If the errors are not found immediately, the trial balance is balanced when setting the difference between the two sides in assets. This is regarded as a temporary accounting in the suspense account. Ensures the balancing of the trial balance and allows draft financial statements. It also allows errors to be corrected by double entry and ensures that all errors are found. Closing suspense account. As the errors are found, they are corrected by means of journal entry. The appropriate entries have been made in the ledger account. And all the errors have been found and corrected, the suspense account will close automatically. Balances. If all the errors affecting the trial balance of trial balance are discovered and corrected, the suspense account will automatically close. The balance remaining on suspense account indicates that there is still some errors in the account. Return profit of correct. The errors are discovered after the income statement and necessary to amend the profit. Any corrections made by items to appear in the trading any corrections made on items appearing in the profit and loss statement on effect on statement of financial position of corrected. If errors are discovered and corrected after the position of financial statement of the profit for the year has been corrected, but this will also calculation of that. The other items also will be calculated. Incomplete records. How to start and finish studying. Have a good view of the entire syllabus. Study each topic thoroughly, work out examples, practice examinations, practice unit examinations, and practice. In this lesson, we learn everything about what is incomplete records, concept of capital, how to evaluate international accounting standard, markup versus profit and loss, how to calculate the cost of loss. Altogether, we discuss and practice questions about these concepts. Identify and practice examination. Incomplete records. Sometimes businesses, small businesses, particularly do not want to trial balance cannot be prepared until a certain amount of calculated calculations have been carried out. Much depends on the record planning. Advantages of maintaining double entry records. Maintaining a full set of double entry records is important for us. Full details are available about the assets liabilities. The preparation of financial statements. The calculation of the profit or loss in the year is likely to be reliable and more informed decision making is possible. The greater degree of control over business activities for businesses. The possibility of fraud is reduced. Comparison with the results of previous years and with other businesses are possible. Detailed records are available for other businesses. Information required by bank or other lender is readily available. Statement of affairs. The only records available are those relating to assets and liabilities of the business. It is not possible to prepare income statement. These assets and liabilities are listed in statement of affairs, which is similar to statement of financial position. The list of assets and liabilities is prepared without the use of set of double entry records. It is known as a statement of affairs rather than a statement of financial position. Formalized assets, liabilities, and capital of the business are known and no further information is available. The only way in which profit can be measured is to compare the changes in the capital of the financial statement. Capital increases when a profit is made and decreases when a loss is incurred. The basic formula for calculating profit is closing capital minus working capital profit. Part of the difference between the two capital figures may be caused by the drawings made by the owner. Drawings have taken place during the formula will be modified to closing capital minus working capital plus drawings. Additional capital has been introduced in this will also be accounted for some of the difference between the two capital figures. The formula must be modified to closing capital minus working capital plus drawings when its capital introduced equal to profit. Cash discount. Allowed and received must be included in calculation of credit suit and credit subject purchase. The discounts must also be recorded in the profit and loss section of the income statement. Markup margin and inventory turnover. When dealing from complete reports, sometimes necessary to use percentages to calculate basic information. Markup and margin. These both measure the gross profit and the percentage. The markup is the gross profit measured as percentage of cost. The margin is the gross profit measured as percentage of selling price. Rate of the inventory turnover. It is sometimes necessary to use calculations relating to rate of inventory turnover and they calculate an unknown figure in the telephone section of the income statement. The rate of inventory turnover is the number of times a business replaces inventory in a given period of time. The formula for calculating the rate of inventory turnover is cost of sales upon average inventory. Profit from the depreciation of non-current assets. How to start and finish. I have a bird's eye view of entire syllabus. Study each topic thoroughly. Work out examples and statements and exercises. Repeat until you understand. Practice exam questions. Practice non-exam. Simulate exam submissions and practice. In this lesson, we learn everything about what is accounting for disclosure wrong. The special case of estimate. Altogether, we discuss practice questions. Identify Different statements and statements. Depreciation. Depreciation is an estimate of the loss and value of most of the non-current assets of yeah. The accounting record is therefore necessary to require the exact amount will only be unless it is the whole concept of the non-current as it matches up for capital expenditure against the financial charge for depreciation. Yes. The principle of best loss is ordered that causes of depreciation. The four main causes of depreciation physical deterioration, the result of non-current can also be referred as or interest or gains. Economic reasons, the non-current asset can also be referred as new and passage of this arises where non-current depreciation. This arises in connection with current assets. The worth of the asset varies methods of calculating depreciation. There are several methods which can calculate the loss and value of assets. Different types of non-current assets are often depreciated. Selected is the one once a value has been selected for a particular asset, this is an application for the principle of practice. Factors of calculation for the principle. That how long is the asset expected to last? How can the there are three main methods of straight line method of depreciation is also known as annual depreciation. This causes as expected loss of this expresses the annual depreciation. This method occurs the value of the asset can fall if there is no advantage. Less the depreciation. The figure of constant value of the asset can earlier asset depreciated by total advantages and disadvantages of the reduced Recording depreciation. Recording depreciation. Each type of non-current asset is two ledger account for recording the cost and account for recording the depreciation. The asset account always in the current and account. The two accounts is always in the recording depreciation. Recording depreciation plan. The depreciation for the each type of asset is paid and is limited to the investment. Depreciation is a non-monetary expense. Depreciation plan. Rather than that, recording depreciation is to the rate of state. The difference between these two is next depreciation of the financial statement. The balance of account. Dictate the depreciation. The depreciation part as part of the provision for depreciation part disposal of non-current. After the disposal, capital says after the disposal. The cost of the asset and the depreciation of assets are deposits of the sale are on the this is because the depreciation was all the years. Asset is sold and the actual loss value is loss. I profit this actual days of acquisition and more than the days of acquisition. Otherwise, calculate depreciation for every unit in the year for the year. Exceptional depreciation. And then when after the calling of the calculation, carry value is less than the actual. In this case, asset is said to be there. This happens asset. The law should be done. In order to calculate the depreciation, this is calculated by dividing the carry. Part exchange of non-current. That is the part exchange value. The revaluation method of items are treated as non-current assets. Each asset may have however full value quite large. In this case, the revaluation and the next is provision for depreciation and accounting costs. Provision for depreciation are meant to compensate for matching the cost of current assets. If the cost of using non-current assets was not increased, the profit will be raised. Partnership accounts, introduction and fundamentals. How to start a study. How a business side from industry study is like really workout example. The next step is repeat until you understand. Practice exam questions. Practice simulate exam questions and practice. This lesson we learn everything about what a partnership is, the difference of partnership, partners, capital account versus grant account, the concept of partnership appropriation account, how to prepare the income statement of financial, the pros and cons of the partnership. Altogether, we discuss and practice questions based on this concept. Identify and practice examination problems. Partnership. The earliest chapters related to business which are owned by only one person is what to do. Another very common form of business is partnership. Partnership is a business in which two or more people work together as owners with the aim of making a profit. Obviously, these cannot be, there cannot be more than 20 partners in a business for business because it is accounted and often operated as a partnership. A large number of family businesses also run as partnerships. Sometimes a new business is formed as a partnership. Sometimes a partnership is formed in a software official sales. Sometimes a partnership is formed and two or more software income. A partnership business will maintain double entry records in the CFA end of the financial year. Income statement and statement of financial position are prepared. However, a partnership will prepare an extra account after the income statement. This is known as the profit and loss operation. Advantages and disadvantages. The advantages and disadvantages of partnership. Before agreeing to enter into partnership business, a person must consider the likelihood. The advantages and disadvantages are normalized as follows. Advantages: additional finances are available, additional knowledge, experience, and skills are available. The responsibilities are shared, the risks are shared, decisions are taken can take place before decisions. Discussions can take place before decisions. Disadvantages: profits have to be shared among the partners. Decisions have to be recognized by all partners. Decisions will take longer to put into effect, and then one partner's actions on behalf of the business are valid. Disagreements can occur. All partners are responsible for debts of the business. Partnership agreement. Partnership agreement is a document setting out the rules and the partners after the profit sharing. Contents of partnership agreement. Although it is not legally necessary to draw the partnership agreement, it is advisable to do so. Drawing of an agreement can avoid misunderstandings and arguments. The clauses of the partnership agreement may cover many aspects of the business. Those related to accounting will include the following. Contents of partnership agreement. Amount of capital invested by each partner. Partners do not need to invest the amount. How profits and losses are to be shared. Profit and losses will be shared equally or in some other ratio. If interest on partners' capital is to be paid, and if so, at what rate? This interest is a reward for investing in the business rather than elsewhere. If all the partners invest the same amount, it may not be necessary to pay interest to their partners invest different amounts. Interest can be a form of compensation to the person who has invested most capital. Contents of partnership agreement. The partner salaries are being made if so all partners share the work on responsibility. The salary can be a form of compensating for the partner and agreed share of work. If an upper limit is to be placed on partner so on, the business will benefit from partners keep drawings and work. If interest on partner drawings is to be charged, so on. This is a method of discouraging partners from making drawings. Interest on drawings and loan. Interest on return back is calculated from the rate of return. Interest on partners extra. To compensate for the loss of interest that is otherwise an interest on loan. Interest loans from partners. Partnership and borrow money from another partner is extra but particularly for business time. Loans from partners are not part of the capital business and are treated in the same way as investment. Unlike investing additional capital, to partnership interest on the loan is a business expense and not affected by the loss. Separation of profit and loss appropriation. Separation of profit and loss appropriation account of partners. Profit and loss appropriation account for the financial year of the the profit for the year transferred to this account and this must be added to the profit. The appropriation of profit share salaries are deducted. The remaining figure is known as the residual profit and is shared with the partners in the agreed partnership relation. Partners capital account. Similar to sole trader, each member of partnership business has their own capital account. These usually record from an increase or decrease in capital by the individual partner. Capital accounts prepared in this way are referred to as capital accounts. Capital account has a credit balance in the business overseas to the partner. Partners current accounts. Each member of partnership business also has a current account. Anything with the partner is generated to the interest of the anything with the partner is charged in single drawings and interest on partners current account. Credit balance and a current account to credit amount of the partner. If the partner's drawings are more than equal the business, if the partner's drawings are less than the amount of the current account will have a credit balance and the business service. The current accounts are not capital partners. Drawings and interest payments for the foreign drawings. A drawing account is maintained for each partner. The total of this account is transferred to the partner's current account and the transaction. Capital versus current account. Only permanent increases and decreases in capital are entered in the partner's capital account. Anything with the partner entered or charges during the year is entered in the partner's account. Capital and current account. Maintain both the capital account and current account for each partner. The current account shows the profit return as well as the drawings exceed the total. Statement of financial position of partnership. Preparing of the statement of financial position of partnership. The statement of financial position is same as that of sole trader in the exception of the capital section. This must show the capital account and current account balances for each partner separately. It is not necessary to show all the details of the transaction in the current account. It is adequate to show the closing balance on each account. Control accounts. How to start and finish study. Having first the entire syllabus study is to thoroughly work out examples, illustrations, and exercises. Repeat until you understand. Practice examinations. Practice modeling and simulate examinations and practice. This lesson we learn everything about what sales and purchase control account control account sales and purchase ledgers, how to control inventories in the statement of financial position. Altogether we discuss and practice questions based on these concepts. Identify and practice examination techniques. Control accounts. Control accounts are also known as total accounts. The trial balance goes to balance. and the error cannot be readily detected, it is necessary to check all the accounting records. This can take a considerable amount and the accounting records. The checking process can be speeded up if control account process like I mentioned in the function control and control account. Like the trial balance, the error is submission information will not be sales ledger control account. Sales ledger control account is an accounts summary of all the accounts of the customers. Sales ledger control account is an account summary of all the accounts of the advantages of control accounts. There is concept of accounting for and purchase ledger control. The advantages of very the balances of these accounts are divided. But all financial statements can be compared with the balances. Those particular ledgers will always be this needed to this is ledger account. Trend is may not be there. Says ledger control. This also required to total receivables. Typical sales ledger control account. So it will be repeated with sales and check this one and difference customers sales cash receipt. Cash receipt. Says all this we can irregular he says ledger control is all about the similar to all the great purchases created discharge. So other things like suppliers, cash, bank, this concept is balances on both sides, especially if it's customers operation is factor into the overpayment and customer assets. This is the general control of any credit balance is another limits. The account can then be balanced balances on both sides. This account can is calculated and overpayment to the supplier and cash discount on this is the purchase ledger control of debit balance contra entries are also interledger transfers. Transfer is made. Bank reconciliation statement. How to start and finish study. Have a bird's eye view of the entire syllabus. Study each topic slowly. Work out examples, illustrations, and exercises. Repeat until you understand. Practice exam questions. Practice mock exams. Simulate exam conditions and practice. Bank reconciliation statement. In this lesson, we learn everything about what a bank reconciliation statement is, what are the causes of it, how to adjust your trial balance after the cash statement. Altogether, we discuss and practice questions. Identify and practice exam questions. Bank statement. A bank will send a statement at regular intervals to its customers during the transaction that has been taken. During the period covered by the statement, shows the bank balance. This is similar to the statement of account issued to the customer. In Bank statement is a copy of the customer's account in the books of the bank. This is a record of transactions of the bank. When money is paid into the bank, the customer's account is credited as this is the amount owed to the bank to the customer. And when money is taken out of the bank, the customer's account will be debited as this reduces the amount owed to the bank to the customer. A positive bank balance will appear as a credit balance and an overdrawn balance as a credit debit balance. Comparing cash book with bank statement. The entries in the bank statement are compared to those in the bank account. In the cash book, it will be found that there are recorded an opposite side of the account. The bank account is a record of the transaction. As money paid in the bank is debited, the bank is a write-off for this amount. As money withdrawn from the bank is credited, the bank is write-off for this amount. It is important to compare the bank statement and the bank account in the bank cash book. If the two balances disagree, it is necessary to reconcile them to explain why the differences are. The opposite side. The entries in the bank column of the cash book will appear on the opposite side so that only they are recorded on the bank statement. Causes of difference. Reasons why the bank statement and the bank statement differ. Bank account and the bank statement differ. The differences between the two records usually occur because of the different times at which the same amounts are recorded. The business not recording certain items in the cash book. Timing differences. There are usually due to checks not presented. These are checks that have been paid to the business and entered on the credit side of the cash book, but which do not appear on the bank statement. This may be because the payee has not paid the check into his bank, or because the check is still in the banking system and not entered. Amount not credited. These are cash and checks that have been paid in the bank and entered on the debit side of the cash book, but which do not appear in the bank statement. It usually takes a few days before the money paid in the bank is recorded in the customer's account. Items not recorded in the cash. So it often happens that the business does not record certain items until the bank statement is received. These include bank charges and bank interest. The bank may deduct an amount from the customer's account to cover the cost of running the account and for any interest charge on overdrafts and loans. Dishonored checks. A check paid to the bank will return because the drawer did not have sufficient funds in the account. Amount paid directly to the bank. These are amounts paid directly by the bank to the other. These include credit transfers, standing orders, and direct debits with the business has interested to pay bank to pay directly from the account of the business. Differences investigated. Any other differences between the two records must be investigated. Errors made with the business should be corrected, and errors made with the bank should be corrected to the bank. The differences between the bank account in the cash book and the bank statement are as follows. List of items. The differences between the bank account in cash book and the bank statement. Items in cash book not in bank statement. Checks not in credited. Amounts not yet credited. Errors in cash book. Items in bank statement but not in cash book. Bank charges and bank interest. Dishonored checks. Standing orders. Credit transfers. Direct debits. Errors and bank statement dividends. Stages of bank reconciliation. Compare the bank account in the cash book with the bank statement. The debit side of the bank account should compare with the credit side of the bank statement. And the credit side of the bank account should compare with the debit side of the bank statement. Equate it against those items which appear in both records. Stages of bank reconciliation. Update the cash book. Enter in the column by any items which appear in the bank statement, but do not enter in the cash book. The items debited in the bank statement. Example, bank charges, credit transfers to the bank should be credited to the bank account in the cash book. Items credited on the bank statement. Example, credit transfers and direct debits paid to the bank should be debited to the bank account in the cash book. Stages. So correct any errors in the cash book. Balance the cash book and carry down balance. This balance is the correct bank balance. If it is the end of the financial, this is the balance which appeared in the statement of financial position. Prepare a bank reconciliation statement. This show how why the balance on the updated cash book does not agree with the balance shown on the bank statement. You start with the balance shown on the bank statement. Add any items which appear on the debit side of the cash book but which do not appear on the bank statement. Amounts not yet credited. Deduct any items which appear on the credit side of the cash book but which do not appear on the bank statement. Make any adjustments for bank errors by adding amounts debited in the error with the bank. Any deducting amounts credited in error with the bank. The total of the calculation should equal the updated bank balance in the cash book. Another way, it is possible to start the bank reconciliation statement with the updated bank account balance. In this case, it is necessary to reverse items B, C, and D. Bank reconciliation statement does not form part of the relevant records of the business. It is a statement which shows that on a certain date the bank account and the bank statement balances for reconciliation. bank reconciliation when there is a bank overdraft. Exactly the same principle are allowed or followed when there is a bank overdraft. In this case, it is important to take great care with the arithmetic calculation that it is helpful to place brackets around overdrawn amount. The bank overdraft will appear as a credit balance in the bank account in the cash book of the bank business and as a debit balance of the bank statement. Advantages of bank reconciliation. The advantages of reconciling the balance of the bank statement is shown in the bank account in the cash card. After updating the bank account, an accurate bank balance is available. Errors in the bank account or on the bank statement can be identified. It assists in discovering fraud and embezzlement. Amounts not credited to the bank can be identified. Check not yet presented can be identified. Any stale checks, these are usually those which are over 6 months old, which cannot be made by the bank, can be identified and written back into the bank. Bank reconciliation statement. So this is how the bank reconciliation statement is. Balances per cash. If you start with balances per cash, debit balance or good balance, that is good balance. So you add unpresented checks. Those are checks issued not presented for payment. So deduct items not credited on bank statement. So that will give you balance as per bank statement. So the other way, balance, when you start with balances per bank statement, less you have to deduct unpresented checks, checks issued not presented for payment, add items not credited in bank statement. That will be balance as per cash. Irrecoverable and doubtful debts. How to start and finish studying. How you have a bird's eye view of the entire syllabus. Study each topic thoroughly. Work out examples, illustrations, and exercises. Repeat, repeat, repeat until you understand. Practice exam questions. Practice mock exams. Repeat exam conditions and practice, practice, and practice. In this lesson, we learn everything about what is irrecoverable debt, what is doubtful debt, what is the difference, what is debt recovered, how to account these items. Altogether, we discuss and practice questions based on these concepts. We identify and work out exam style questions and income statement and statement of financial position, including adjustments from irrecoverable and doubtful debts to exam questions. Irrecoverable debt. When goods are sold on credit, the customer is allowed to pay for the goods at a later date. There is always a risk that the customer will not pay for the goods. And irrecoverable debt is an amount owing to the business which will not be paid by the credit customer. This may be because the customer has disappeared and lost the business or because he is unable to pay. If all reasonable steps to obtain payment have failed, the debt is default. The account of the customer is closed by transferring the amount written up to the irrecoverable debts account. At the end of the year, the total of the irrecoverable debts account is transferred to the income statement where it is regarded as investment for the year. Writing off. Writing off irregular debts is an example of the application of the principle of prudence. If a debt cannot be regarded as an annuity to be written off so that the assets are not overstated, the amount of the irregular debt is regarded as a loss for the year and included in income statement. Otherwise, the profit for the year will be overstated. Recovery of bad debts written off. Bad debt, a debt written off may be recovered if the credit customer pays some or all of the amount owed after the account was written off. The amount of the customer has been closed, the amount received is debited to the cash and credit is recorded. An alternative method is instead that by creating the debt recovery account and taking the customer the amount pays to written off. The amount received will then be entered by repeating the value and paying the customer. The advantage of this method is that all transactions paid to the customer. Year end adjustment. At the end of the year, the total of the debts recovered account can either be transferred to the income statement as income for the year or transferred to the credit of the recovered debts account where it reduces the debts written off in the year. Reducing the possibility of illegal debts. The only certain way of avoiding illegal debts is not to sell goods on credit. In practice, is not for not always all possible steps must be taken to avoid illegal debt before allowing credit to any customer. Credit preferences should be obtained only from the customer bank or previous suppliers. A credit limited is usually fixed for each customer, which places an upper limit on the amount the customer can overpay at any one time. The establishing of the credit limit and the later monitoring of the customer's credit. Invoices and non-tenant statements account should be issued. The sales ledger account should be created. Any OD account should be investigated. The customer contacted by letters given and consequences. No further goods should be supplied until the amount due is paid. A more extreme measure involves taking legal action against the customer, but sometimes the amount of the debt is too small to justify costly legal proceedings. Provision for document. Provision for document is an instrument of the at the end of the financial year, many business try to anticipate the amount to loss the person will result. They ensure the loss of the year is not overstated is one at a realistic level. This is an implication of the principle of risk. Maintaining a provision for the business also is the principle of matching. The amount of sales for which the business is unlikely to be paid is divided than the year in which those sales are made rather than the expense of the year in which the debt is actually written off. Estimation. In order to make a provision for the total debt, it is necessary to estimate the amount of total debt. The amount of provision may be established by looking at the customer and upon estimating on the basis of past experience the percentage of total considering the length of the time debts have been outstanding. A provision of higher percentage will be given on order than the longer a debt is outstanding, the greater the risk. Creating a provision for doubtful debts. Once it is decided to create a provision for doubtful debts, the amount of percentage this can be recorded in the these entries are needed by the document. The entries are summarized as the debit income statement create the provision for doubtful debts account. In the statement of financial position, reduce the balance of the provision for doubtful debts amount from the trade risk. Adjusting a provision for doubtful debts. In future, it may be decided to maintain the provision for doubtful debts with the same percentage of the trade risk. The amount owing and increase the provision need to be increased and vice versa. If the original provision for doubtful debts are based on the amount rather than a percentage, it may be decided based on this adjustment for the provision. The entries are summarized as follows. Limit the provision for the with the provision and carry down the trade. Transfer the difference on provision from the cash account to the income statement. In the statement of financial position, it is the balance of the provision from the next account. The new provision from the trade receipt. How to calculate the amount for depreciation, amount for provision for debt. The calculation of a provision for doubtful debt depends on the type of provision required. There are three kinds of provisions: specific, general, specific, and general. Specific. Certain debts are selected from the sales ledger as doubtful. The provision will be equal to the total of those debts. The amount of provision is based on specific knowledge the business owner has of a particular customer's financial condition. How to calculate the amount for depreciation for doubtful debts. Specific provision must always be deducted from trade receipt first before the general provision is calculated. In other words, specific provision is defined and specified from total reserve. They may be doubtful debts specified as such. General, the provision is calculated as a percentage of total trade receivables. The average percentage of debt by amount that proved to be usable is specific and general. The provision is made up to the debts that are thought to be doubtful plus a percentage of the remainder. Irrecoverable versus doubtful debts. Irrecoverable debts are never provided for. They should always be written off as soon as they become irrecoverable. So therefore, never refer to a provision of irrecoverable debts. Irrecoverable debts recovered. A debt that has been written off as irrecoverable may be recovered at a later date. If the customer becomes able to pay, the debt must be recorded on the customer account will be debited and local debts recovered account credited with the amount recovered. The amount received from customer may then be credited to this account. The balance on vehicle debt recovered account will be credited to income statement sheet. Again by way of journal. It should be shown under gross profit as part of the other income and should be added to the gross profit. Alternate treatment of vehicle debts recovered. Sometimes only the difference between the balances of vehicle debts and account and vehicle debts recovered account will be included in the income statement. If the net difference is an expense, then it is included in the income statement with other expenses. If the net difference is a credit, it will be added to the gross profit as well as the income. Accruals and prepayments. In this lesson, we learn everything about cash basis versus accrual basis, the concept, the practical application of the matching principle, how to record accruals and prepayments in ledger accounts, how to adjust trial balances for accruals and prepayments, effect on income statement and statement of financial position, inventories of consumables, two-way account versus statement, identify. Altogether, we discuss and practice questions based on these concepts. Exam style, income statements and statements of financial position, including accruals and prepayments, exam questions. Cash basis versus accrual basis. In cash basis, transactions are recorded as and when cash is received and paid. Matching concept has less relevance here. In accrual basis, transactions are recorded considering the matching concept. If it is an expense but has foreign due, then the transaction is recorded even if it is paid. Year-end adjustment. It is often necessary to make adjustments to the accounting records in order to present a more accurate view of the profit or loss of the business and the financial position of the business. Such adjustments are referred to as year-end adjustments. It is common to find expenses or income unpaid or to find expenses or income paid in one financial year but which relate to other financial years. Only items relating to that particular time period should be included in the statement. The timing of the actual receipts and payments is not relevant. An income statement is prepared for a definite period of time. The period of time covered by the statement being included as part of the statement. How to record inventory of stores on expense accounts. Some expense accounts represent inventories of consumables. Examples are stationery, heating fuel, and fuel for motor vehicle. Inventories of consumable stores may be unused at the year. According to the matching concept, these inventories should not be charged against profit for the year. They are an asset and not an expense at all at the year end. Carry them down as a debit balance of the account. This may result in an expense account having debit balance and credit balance in the year. In the statement of financial position, the inventories of unused consumable stores will appear under current assets. They should be shown under their own heading of, say, inventory of unused stationery. They should never be included in closing trading inventory. Practical application of the matching principle. This is a practical application of matching principle. It is necessary to adjust the items within an income statement for amounts prepaid or accrued. This means that the profit or loss will be shown at a more accurate figure, and it allows for more meaningful comparison of the individual statements. The use of a symbol diagram is often helpful when calculating the expense or income and relating to a particular financial year. This is illustrated in the examples used in this chapter. Accrued expenses. An accrual is an amount due in an accounting period which remains unpaid at the end of the accounting period. Where an expense is accrued, it means that some benefit or service has been received during the accounting period, but this benefit or service has not been paid for by the end of the period. To apply the matching principle, the amount transferred to the income expenditure into the income statement should represent the expense for the income accounting period covered by that account. This means that any amount due but unpaid at the end of financial year must be added to the amount paid and the total expense relating to the accounting period transferred to the income statement. The expense account will now show a balance equal to the amount unpaid. To complete the double entry, this balance is brought down on the credit side of the ledger account. As the balance represents an amount owing due to payment in near future, it will be included as a current liability in the statement of financial position. Prepaid expenses. Prepaid expenses. If prepayment is an amount that is paid in advance where an expense is prepaid, it means that a payment has been made during the financial year for some benefit or service to be received in future accounting period. As with the accrued expenses, the matching principle must be applied so that the amount transferred to the income statement represents the expense for the accounting or the rest. Any amount paid during the financial year relating to the future accounting period must be directed to the amount so paid so that only the expense relating to the accounting period is transferred to the income statement. The expense account will now show a balance equal to the amount paid in advance. To complete the double entry, this balance is brought down on the debit side of the ledger account, as the balance represents a short-term benefit which the business has paid for but which is not used, that will be included as a current asset in the statement of financial position. Opening balances on expense account. The trader mentioned if in his first year of business, none of the expense accounts prepared will have an opening balance. There might, however, be a closing balance on each accounting statement, the opening balance for the year of trading. This must be considered when calculating expense related to the next financial year. Combined expense account. Sometimes a business may use one ledger account for two different but related expenses. The same principle are applied to those for an account containing a single expense. The only difference is that there may be two opening and closing expenses. Accrued income. Where an item of income is accrued, it means that another person receiving the benefit or service from the business during the accounting period is not paid for the benefit or service to the accounting period. The totals of income period in the nominal ledger are transferred to the income statement at the end of the financial year. The matching principle is applied to income in the same way as it is expensed to the so that the amount transferred to the income statement represents the income for the accounting period covered by the statement. This means that any amount due but not received at the end of the financial year must be added to the amount received and the total income relating to the accounting period transferred to the income statement. The income account will now show a balance equal to the amount not yet received. To complete the double entry, this balance is brought down on the debit side of the ledger account as the balance represents an amount owing to the business due to received in near future. It will be included as a current asset in the statement of financial position. Prepaid income. Where an item of income is prepaid, it means that a person has paid for a benefit of service from a business, but this has not been provided by the business at the end of the financial year. Once again, the matching principle was applied so that the amount transferred to the income statement represents the income of the accounting period covered by the statement. Any amount received during the financial year relating to future accounting period must be credited to the amount received, so that only the amount relating to accounting period is transferred to the income statement. The income account will now show a balance equal to the amount received in advance. To complete the double entry, the balance is brought down on the credit side of the ledger account. This balance will be included as a current liability in the statement of financial position, as the business has a liability to provide some service or benefit for which the business has already been paid. Opening balances on income accounts. The second and subsequent years of trading, a business may have opening balances on income account as well as opening balances on expense account. These must be considered when calculating income relating to that particular financial year for which the accounts are prepared. Focus on closing balances. Assets have opening debit balance but closing credit balance will become debit balance in next accounting period. Liabilities have opening credit balance but closing debit balance will become credit balance in next accounting. Accounts of limited companies. How to start and finish study. I have website syllabus. Study each topic thoroughly. Work out examples, illustration from the syllabus. Repeat until you understand. Practice exam questions. Practice mock exams. Simulate exam questions. An introduction to the account of limited companies. This lesson will learn everything what limited companies are, partnership versus companies, legal requirements of companies, format of financial statements as per companies, sources of companies, share reserves differences, bonus issue, rate issue. All together we discuss and practice questions. Identify and practice. Limited company. Limited company is a legal entity which has a separate entity from shareholders whose liability for the company's debts is limited. Sometimes a new business is formed as a limited company. Sometimes a limited company is formed in a sole trader or partnership which span the share capital. The nature of a limited company, one person acting alone can form a limited company and there is no non. The capital of the company is divided into shares which can be of the member shareholders of the company are only liable for the debts of the company up to the amount they have been to pay. Since a company can have large amount of shares, members whose liability is limited, a large amount of capital can be raised. The shares of the company have a face value per value such as $1. Profits are distributed to members, which are often stated in terms of this way. Public limited was. There are two types of limited shares and is not allowed to operate shares. Limited liability. The viewpoint of the benefit it is also beneficial that a limited company has a separate legal entity. Legal action are taken in often very small for shareholders to take an active part in the board of directors. Rated. From the viewpoint of the business being a limited company, that it is possible to access it is possible for a shareholder of partnership. Loans can often be obtained from a business or a partnership. The company has continuity of share capital required, members of the issue share capital required for the shares. A company will not immediately deploy all of the shares its issues. In this case, shareholders will be allowed to pay installments of time price. Total amount of money has to be shareholders. This may be less than the issued capital. The company may only call up the amount it actually requires on that date. The term paid up capital refers to that part of the capital called up the whose company has actually received capital. Types of share. Share capital of a limited company will be divided into different types of shares. Ones are preference shares. Preference shares. The name implies this is the preference for the organization. This is which is payable before any company is paid. Dividend is the same every year, provided that the profit is down and left after paying. Before anything is done to the organization, shareholders are not actively entitled to shares. Types of preference. The several types of preferences are also however, it is listed the preferences are dependent on the profit and loss account. Dividend appearing at liabilities. Preferences are shown. The preferences are not organizations. These are also known as equations. The different organizations after the preferential the trading results are for the organization. Trading results they may want the time. If a company is under that, outside liabilities and preferentials, return to the organization. This may result in little amount of return to the organization. The organization general capital initial version. Redeeming potential. Redeeming potential for these potentials is not by the company. Increase the total funds provided the shares. The figure is around Adventures. Adventures mission will be provided to the members. Often, just carry this slow interest replacing the most of the property. If the company is only the venture owners, shareholders, income statement of limited. Annual statement is prepared for yearly statement is prepared for a sort of only different. Statement of changes. Partnership according to the companies, their profit. To show the profit showing how the profit is statement. Summarizes the changes during the organization. Normally, we the count dividends. Any organization dividend. Financially, audit. Sometimes the directors will recommend dividend. Not pay dividend. To be paid during the year on organizations. Also, non-dividend will appear in the statement. At the end of financial year, the directors of the corporation paid every Here, they are included in the statements. Very often you will not distribute the whole of the profit that they have. Even if it is given in a limited to distribute the whole profit, it will not be possible. Not a profit. Any profit that is not appropriated for the business in addition to leaving the balance of etc. This is another principle. The general result also of this responsibility and statement of an statement of an basis criminal administration, criminal administration, and any other non-public section has to be depends on the presentation. The gender is a lieutenant surrounded to the accounts of manufacturing business. How to start and finish study. I have a bird's eye view of the entire syllabus. Study is taught to work out examples, illustrations, and exercises. Repeat until you understand. Practice exam questions. Practice problems. Simulate examinations. Practice. In this lesson, we learn everything about how to prepare manufacturing, formats, sequence, how to calculate manufacturing, how to provide for inventories. Altogether, we discuss some practice questions. Manufacturing business. The previous chapters relate to business which are not in trade, such as wholesale or retail, sell them to the channel, or service businesses. There are, of course, manufacturing businesses, very often. The manufacturing business would remain low in labor costs. The manufacturing business would maintain the costs. At the end of the financial year, in addition to an statement, possibly an appropriation of that statement. The purpose of preparing this account is to calculate how much it has cost the business to manufacture the goods. Manufacturing account is part of annual financial statements. The elements of cost of manufacture is made up of four elements. The first thing manufacturer makes is raw material. This raw material takes the vehicle will need road, a furniture, a carpenter, sometimes. The next essential cost of manufacture is the cost of goods. Depending on the equipment, the vehicle's consumption. This cost is the term direct labor includes only those people who are actually not in production of finished goods. It does not include the wages of supervisors and staff. These people are regarded as the elements of cost, direct expenses. There are many expenses which a manufacturer can directly link to the product. Maybe that for every item produced, manufacturer has to pay. Manufacturer may have to pay a special such as factory overheads. These are sometimes referred to as indirect expenses. They include all the costs of all the marketing, which cannot be directly being manufactured. Expenses such as factory machinery, depreciation of manufacturing, direct expenses as factory overheads. Preparation of manufacturing, cost of manufacturing is used for this kind of the cost of manufacturing is that in which a retailer can cost of manufacturing actually opening inventory of manufacturing minus plus carriage inventory of raw material minus closing inventory. Cost of the direct labor. The total of these elements of cost is direct material. The total cost of production is not adding the total cost of work in progress. Goods which are partly completed at the end of the production. Work in progress is the cost of production. They do have some value, however, it has cost to something to them to get their the partly made goods at the end of the manufacture in manufacturing what is necessary to achieve the adjustment is done in the same way as the one as per on any other type of calculation of the manufacturing is done on the trading section, preparation of trading section. The gross profit of the manufacturing business is calculated. Is very similar to the compared to the main business because the business action the item for purchase is sometimes our manufacturing is something which is not manufactured. So this may occur when production does not meet the manufacturing to the extra in this particular item. Purchases of finished goods are added to the production. The trading section those finished goods. This means that the inventory is included on inventories of finished goods. And the end of the information. Profit and loss section. Information of profit and loss section. It is very similar to that prepared by expenses in manufacturing. So only administration expenses, selling and distribution expenses, financial expenses. Allocation of expenses. When expense relates to the whole of the business, it is necessary to share this whole factory and process. Expenses such as insurance of buildings, content rights, and rate of for example, the insurance portion. 2. the factory and used to put the estimate that is the total cost of insurance of 900. Financial information of the statement of financial position statement. There is only one difference. Three differences. Not three. It is really to show each of the year and business. Year and business. This chapter is complete. Not temporary. Non-profit organizations, clubs and societies have to start and finish studying. However, study is not very important exam. Repeat until you understand. Practice examinations. Practice competitions. Simulate examinations. In this lesson, we learn everything about Newton's non-profit new forms of management. Non-profit organizations. Concept. This have to concentrate on the concept of non-profit organizations. Is to provide some facilities making the profit. Examples of such organizations: financial development, in some cases, a concept of development. Usual, more usual to find that only all of these these are values. To the society and these financial statements we enter in the form section. Creation of basics and benefits. Basics and benefit form is the all money listed is limited to is credited. The account is balanced and the balance credited. So the bank or balance may represent activation and debit balance is an asset and represents owned by the society where balance. Receipts and payments account just like you did in the past. Receive and credit. No distinction. Distinction. Area the account. Receipts and payments account is all payments. Operation of all the workers carry monitoring, plus application. The end of the financial year, the trade section of such as wages and capital system depreciation should be added to the cost. Surplus of deficit income and expenditure account is prepared. The surplus arises from the gains and provisions, it arises. Preparation of income and expenditure. Income and expenditure account. If the gains are more than the expenses, if the gains are less than the expenses, and income and expenditure account is prepared. Adjustment. Non-monetary items should be depreciation. Such as lab the beginning of the and end of the financial year. Of the activity should be set up. Accumulate fund balance is the surplus is preparation of statement of financial are similar to the planning of financial statement. Current assets not is exactly the same way as the statement of financial. The main difference is that there is capital investment, whereas business is yet financial. Members of the global society do not enter because of the members are not entered. This means that this surplus is going to the that means the deficit that subscriptions. Subscriptions prepaid as a repaid for the subscriptions in the 600 where the income and expenditure account should be the this means that the amount received from the registered subscriptions and any subscriptions paid. The calculation of the amount related to ledger account minus subscriptions. This means the divided amount of the investment. Substitutionary amount because the global society is it is possible to have paid subscriptions. At the end of the financial year, the amount is closed by transfer. Subscriptions. Club may have policies. The increase is because The subscription account is created in the these recommended calculation of sales concept sometimes the same principles apply calculating for a visualization of basis of calculation of automated is sometimes necessary to calculate this can be calculated capital business assets is equal to society assets is equal to accumulated fund plus published company accounts international accounting standards. How to start and finish study. Have a overview of entire syllabus. Study each topic thoroughly. Work out example illustrations and examples until you understand. Practice exam questions. Practice mock exams. Simulate exam conditions and practice. Published company accounts. In this lesson, we learn everything about international accounting standards, reporting standards relating to income statement and statement of financial information. International accounting standard 1, 2, 7, 8, 10, 16. All together, we discuss and practice questions based on these concepts. Identify and practice examination questions. We also learn the financial statements and report that must be published on central shareholder. Reporting standards relating to the income statement. Reporting standards relating to the statement of financial position. The role of the shareholders of the limited company. The role of directors of the limited company. The contents of directors' reports. The role of auditors of the limited company. The importance and convenience of auditors' reports. Generally accepted accounting principles. Accounting standards ensure compliance with the true and fair view concept. All companies are required to comply with accounting standards or to publish reasons for departing. Company auditors are required to ensure that the company accounts are prepared in accordance with the standards and to report any significant departure from the standards issued. The standards help to increase uniformity in the presentation of company accounts and reduce the subjective element in the disclosure of information. International accounting standards have been developed in the form of international accounting standards and international financial reporting standards since 2005 with the aim of harmonizing or standardizing financial reporting. Private UK companies are permitted to choose between international and UK standards. Companies listed on a stock exchange are required to adopt international standards, and many large or multinational private companies adopt them voluntarily. The Cambridge International Examination Syllabus identifies a number of international accounting standards. The content of the student need to be aware of following table identified. Some have already been covered in this chapter. The remaining ones and some are special orders not being covered. Presentation of financial standards in chapter 19, inventories in chapter 16, 22 and 28, statement of cash flows chapter 23, accounting policies chapter 22, events after the statement of financial position chapter 22, property, plant and equipment, earnings per share chapter 22, impairment of assets chapter 22, provision of contingent liabilities and assets chapter 20, intangible assets chapter 20. Chapter 22 is this chapter, so which is mentioned as company financial statements or international accounting standards. This is chapter 22. Accounting concepts. Although not an accounting standard, a conceptual framework has been developed by the body which sets the international accounting standard. This sets out the principles which underlie the preparation and presentation of financial statements. The framework identifies the main uses of financial statements are set out below. The framework surrounding IAS identifies the typical user group of accounting statements. The table below identifies these user groups, stakeholders, and use likely reasons by no means exhaustive for them referring to the financial statements. Main users, reasons for use. Investors to assess part performance as a basis for future investment. Employees to assess performance as a basis for future income, salary, and taxations. To assess performance as a basis for continuity of employment and job security. Lenders to assess performance in relation to the security of the loan to the company. Suppliers to assess performance in relation to the medicine of the company. Customers to assess the performance in relation to the regulatory. Government to assess performance in relation to compliance with the regulations and assessment. Public to assess performance in relation to social. Chapter 9 set out a number of accounting concepts which are important in preparing the financial statements. However, these are perhaps more important in the context of limited company accounts and preparing financial statements. We assume that they are prepared on matching basis and that the business is a good case. IAS 2 inventories. This statement deals with the valuation of inventory which is entered in the income statement and statement of financial position. The term inventory refers to the unsold goods with the business growth. Companies have inventories in a variety of forms. Raw materials for use in subsequent manufacturing process, work in progress, partly manufactured goods, finished goods, completed goods ready for sale to customer, finished goods with the business has bought for resale to customer. The principle of inventory valuation is set out in IAS 2 is inventory should be valued at the cost, lower of cost and net realizable value. This was also covered in chapter 16 in the preparation of accounts from incomplete accounts of discovery. Notice the exact wording, it is the lower of cost and net realizable value, not the lower of cost or net realizable value. The situation when the company holds a number of different lines of inventory. It is rare for a limited company to hold just one particular line of inventory. For example, a clothing store may hold both men's and women's clothes. For men, it may hold shirts and trousers. This will be regarded as individual project lines. In this case, inventory should also be considered on a line-by-line basis. Inventory valuation methods where items are bought and used on regular basis. Certain businesses, particularly manufacturing business, may hold a number of different items which are used in making the product. The cost of these items vary both over time and depending on which the firm buys the item. This causes a number of problems with the valuation of such inventory. IS allows two different methods for use for valuing this type of inventory. FIFO, first in, first out method. This assumes that the first items to be bought will be first to be used, although this may not be physically distribution of goods. This may remaining inventory valuation will always be value of most recently purchased. Average cost. Under this method, any average value, usually the weighted average using the number of items bought is calculated each time and the individual value of inventory is worked out. This is all covered in detail in section 28.5, which reference should also be made. Valuation of inventory at the lower of cost and net realizable value. The principle of inventory valuation is set out in IAS 2. So far, we have seen that inventory can be valued using any one of the two different methods, FIFO or APO. Since these are the only two methods of inventory valuation which IAS 2 allows, we have also seen that whichever method is chosen can achieve the broad purpose of the company. We also saw the standard stage the inventory should be valued at the lower of cost and net realizable value. This is the price that which may be expected to be received from the sale of goods, less the cost of putting them into saleable condition. The cost includes the cost of completing the goods in their manufacture plus marketing, selling, and distribution cost. The term net realizable value can be compared to the selling price of the product. If the expected selling price is lower than the cost price, then inventory should be valued at its selling price. Inventory is never valued at selling price when the selling price is greater than the cost. By using the lowest price possible to value, this means the inventory valuation follows the prudence concept. Similarly, inventories which are similar in nature and used to the company will use the same evaluation method. Only where inventories are different in nature or use can be different valuation method be used. Once a suitable method of valuation has been adopted by a company, then it should continue to use that method unless there are good reasons why a change should be made. This is in line with the consistency concept. Valuing work in progress and finished goods. IAS2 requires that the valuation of work in progress and finished goods includes not only their raw or direct material content but also includes an element for direct labor, direct expenses, and production overhead. The cost of these two items therefore consists of direct material, direct labor, direct expenses, production overheads. These are costs to bring the product to its present location and condition, or other overheads which may be applicable to bring the product to its present location and condition. The cost of these two items excludes abnormal waste in the production process, storage costs, selling costs, administration costs not related to product. Replacement cost. Replacement cost is the price that will be have to be paid to replace goods used or sold. The replacement cost may be the latest price of the good or an estimate of what the price will be at some future date. Replacement cost is not acceptable as a basis for valuing inventory under IAS. However, replacement cost may be used to estimate the cost of a particular job when quoting for an order. Using a price based on historic cost may lead to an underestimate of the price for a job and a lower profit. Replacement cost is usually more realistic for this purpose. Replacement cost should also be used when preparing budgets. See chapter 24. The chapter on budgeting. The standards does not allow to inventory to be valued using the last in first out LIFO method. Last in first out method LIFO method. Similar inventories which are similar in nature are used to the company will use the same valuation method. Only where inventories are different in nature or use can use a different valuation method or be used. Once a suitable method of valuation has been adopted by a company, then it should continue to use that method unless there are good reasons why a change should be made. This is in line with the consistency concept. IAS 8, accounting policies, changes in accounting estimates and errors. This statement deals with the treatment of changes in accounting policies and errors in the financial statement. Accounting policies. These are the principles, basis, conventions, skills, and practices applied by business when preparing and presenting the financial statements. These policies are selected by the directors of the business. In selecting them, they must make sure that these are accounting policies given in an accounting standard. That the policy they select must comply with the standard. When there is no accounting policy provided to give guidance, then the directors must use the review information that is relevant and relevant. The directors must refer to any standard or interpretations to other standard setting bodies to assist them. However, they must ensure that their subsequent interpretation or recommended method of treatment for the transaction does not result in conflict with international standards or interpretations. Examples of accounting policies can include the method of valuing inventories or the method is used to depreciate non-current assets. Accounting policy. These are the principles, basis, conventions, rules, and practices applied by business when preparing and presenting this financial statement. These policies are selected by the directors of the business. In selecting them, they must make sure that where an accounting policy is given in an accounting standard, then the policy they select must comply with the standard. Where there is no accounting policy provided to give guidance, the directors must use their judgment to give the relevant and the directors must refer to any other standard or interpretations or to other standards bodies present. However, they must ensure that the subsequent interpretation or recommended method of treatment for the transaction does not result in conflict with international standards or interpretation. Examples of accounting policies can include method of valuing inventory or the method used to depreciate non-current assets. Accounting principles. These are covered in the statement, although no formal definition is given to them. They are regarded as the broad concepts that apply to almost all financial statements. These would include sections as going concern, materiality, prudence, and consistency mentioned earlier. See chapter 9 further. Accounting basis. These are the methods developed for applying the accounting principles for financial statements. They are intended to reduce sensitivity by identifying and applying a acceptable method. The general rule is that once an entity adopts an accounting policy, then it must be applied consistently for similar transactions. Changes in accounting policies can only occur if the changes is required by standard or interpretation, or if the change results in financial statements providing more reliable and relevant information. Once any changes are adopted, then they must be applied retrospectively to financial statements. This means that the previous figure for equity and other figures in the income statement and statement of financial position must be offered, subject to the practicalities of calculating the relevant. Examples here are the method and rate used by company to depreciate current assets. Another would be the way in which it values inventory. For example, if the value includes material and labor costs or a proportion of factory overhead, alternatively whether free for employees. Dealing with errors. If an error in the financial statements is discovered, the business must correct materials from the prior period in the next set of financial statements. Comparative amounts from the previous periods may be restated, subject to the practicalities of calculating the relevant amount. In this instance, errors are omissions from or misstatements in the business financial statements covering one or more prior periods. There could be something as simple as a mathematical mistake made when preparing the account. It can also include the failure by directors to use reliable information which was available in the financial statements. Top tip. Say the directors are considering changing the way in which depreciation is calculated or inventory value in order to increase the profit per day. It is important to remember that they should not make any changes. So as to do so would mean that this IAS is not being followed. IAS 10 events after the statement of financial position date. These are events either favorable or unfavorable which occur between the statement of financial position date and the date on which financial statements are prepared. Such items may occur as a result of information is become available after the end of the year and therefore need to be disclosed in the accounts. If they occur, then amounts included in the financial statements must be adjusted. They may indicate that doing concern is not appropriate to the financial statements. The key is the point in time at which changes of financial statements can be made. Once the financial statements have been approved by or issued by the board of directors, they cannot be altered. For example, the accounts are prepared up to 31st December. They are approved for issue by the board of directors on 30th April and following. Between these two dates, changes in results from events after 31st December can be disclosed in the accounts. After 30th April, nothing can be changed until the next annual accounts are prepared. The statement distinguishes between two types of events: adjusting events and non-adjusting events. Adjusting events. If at the date of financial statement, evidence of condition existed that would materially affect the financial statement, then the financial statement should be changed to reflect these conditions. Examples of adjusting events would include the settlement after the date of statement of financial position of the court case which confirms that an obligation existed at the date of statement of financial position. The purchase price or profit from the sale of non-current asset bought or sold before the year end was not, but not known about the date of the statement of financial position. Inventories where the net realizable value falls below the cost price. Assets where valuation shows the impairment is required. Trade receivables where a customer has become insolvent. The discovery of fraud or error will show the analysis should be corrected. Non-adjusting events. No adjustment is made to the financial statement for such event. If material they are disclosed by way of note to the financial statements. Example of non-adjusting include major purchase of losses of production capacity caused by fire, flood, or strike causing action by employees. Announcement or commencement of major reconstruction of the business. The company entered into significant commitments or contingent liabilities. Commencing litigation based on events arising after the statement of financial position. Major share transaction, such as the issue of new shares and debentures of capital reductions or reconstruction. There are three situations in addition to the above which require consideration. Dividend declared or proposed of the date of statement of financial position are no longer recognized as a current liability in the financial statements. They are non-adjusting events and are now to be shown by way of note to the accounts. If after the date of statement of financial position, the directors determine that the business intends to cease trading and there is no alternative to this course of action, then the financial statement cannot be prepared on a going concern basis. A business must disclose the date when the financial statements were authorized by issue or and who gave the authorization. If anyone had the power to amend the financial statement after their authorization, then this fact must be disclosed. You may be asked about events occurring after the date of statement of financial position and for redrafted financial statements to take account of charges required as a delivery. Learn the items in the list and apply them accordingly. IAS 16 Property, Plant and Equipment. This statement deals with the accounting treatment of the non-current assets of property, plant and equipment. The issues covered by the statement are recognition of the asset when the item is recorded in the account, the determination of their carrying amount, what value is paid on it, their depreciation charges, their impairment process, what happens when the value of asset is below than that shown in the accounts. Property, plant and equipment are tangible assets held for use in the production and supply of goods and services, for rental, for others and for administrative purposes. They are expected to be used by a business for a period of more than 1 year. For example, a company may buy some plant and machinery at the cost of $15,000, expect the plant to be used for 10 years and at the time of them to be sold for 1 year. The depreciation amount will be 14,000. Assuming the company uses straight line method of depreciation, then each year $1,400 will be recorded as a expense in the income statement. This example allows reference to be made to definitions included in the statement. They are depreciation. This is the allocation of the cost of an asset over each year. This will be $1,400 depreciable amount. This is the cost of valuation of the asset less any residual amount. This will be the figure of $14,000. Useful life. This is usually the length of time for which an asset is expected to be used. This will be the period of 10 years for which the company intends to hold and use the plant. There is an alternative. If the asset is depreciated on the use of on the basis of number of units, it produces then the estimated output of the item over its useful life can be used. Residual value. The net amount the business expects to obtain for an asset at the end of its useful life. After deducting the expected cost in this figure, this will be the figure of $1,000 which the company hopes to sell the assets for at the end of its useful life. The standard also uses some other terms which need to be aware of. Fair value. This is the amount for which an asset could be exchanged between knowledgeable within parties in an arm's length transaction. If, for example, after 5 years the company decided to sell the plant, it may offer its people to buyer at $5,000. This will be regarded as a fair value to the item bought. Carrying amount. This is the amount at which an asset is recognized in the statement of financial position after deducting any accumulated depreciation and impairment. This is, in effect, the net book value of the asset shown in the statement of financial position. At what point does an entity recognize the asset, or put more simply, at what point is the asset to be recovered in the financial statement? This must be done when it is probable that the business will be able to use it to generate revenue and the cost can be assigned to it. If an item of property, plant and equipment qualifies for recognition as an asset by meeting these criteria, then it bought into account and initially valued at cost. Additional costs associated with the asset. The statement recognizes that in addition to the initial purchase price of the asset, other amount may also be spent. This statement provides the following guidelines to assist with the treatment of such expenditure. Day-to-day costs of servicing and repairing the asset should be charged as expenditure in the income statement. Where parts require replacement at regular intervals, say the assets and then these costs can be added to the cost of the asset in the statement of financial position and depreciated accordingly. Where the asset requires regular inspections in order for the asset to continue operating, then the cost of such inspection can also be added to the cost of the asset in the statement of financial position and depreciated accordingly. When the asset is purchased, apart from its original cost, the business may also pay other costs as part of the purchase price. The standard provides information as to what can be included as part of the cost in the statement of financial position. Any import duties, taxes directly applicable to the asset to its present location and condition. The cost of site preparation, initial delivery and handling cost, installation and assembly cost, cost of testing the asset, professional fees, any say architects or legal fees. Valuation of the asset. Once the asset is acquired, the business must adopt one or two models of its valuation. Cost less accumulated depreciation, revaluation. This as the asset is included carried at revalued amount. As revaluations are to be made regularly by suitably qualified people to ensure that the carrying amount does not differ significantly from a fair view of the asset at the date of the statement of financial position. Revaluation should be undertaken by the business with a sufficient regularity to ensure that the carrying amount is up to date. For example, every 3 to 5 years. Unless assets are bought and sold frequently, if an asset is revalued, then every asset in that class must be revalued. Thus, if one parcel of land and building is revalued, then all lands and buildings must be revalued. Any surplus on revaluation is reported in the statement of comprehensive income and transferred to the equity section of the statement of financial position of the differ significantly from the fair value of asset debita statement of financial position. Revaluation should be taken by the business with sufficient regularity to ensure the carrying amount is up to. Up to date every 3 to 5 years. Unless assets are bought and sold frequently, if an asset is revalued, then every asset in the class must be revalued. Thus, if one parcel of land and building is revalued, then all land and buildings must be revalued. Any surplus on revaluation is reported in the statement of comprehensive income and transferred to the equity section of the income of statement of financial position of the revaluation reserve. This may not be used to pay dividends to the shareholders. Any loss on revaluation is recognized as expense in the income statement unless the revaluation reserve has surplus in the same asset. Depreciation. The expected life and residual value of the asset are to be reviewed at least annually. If there is a difference between the previous estimate, this must be recognized as a change in estimate under section IAS 8. Accounting policies changes in accounting estimates. Depreciation must also continue to be charged even in the fair value of asset that is carrying. However, depreciation need not be charged when the residual value is greater than the carrying amount. Depreciation is to be included in the expense in the income statement. The business must choose a method of depreciation which reflects the pattern of its usage. Ideally, once the method has been decided, this should not be changed. It is possible, though, to review the method. And if a change in the pattern of usage of asset has occurred, then the method of depreciation will be changed to depreciation. Such a change would come under IAS. Disclosure in the financial statement. For each class of property, plant and equipment, the financial statements must show the basis for determining the carrying amount, the depreciation method used, the useful life of depreciation rate, the gross carrying amount at the beginning and the end of the accounting period, the accumulated depreciation and impairment losses at the beginning and end of the accounting period, additions during the period, disposals during the period, depreciation and impairment for the period. These are likely to be shown by way of non-current asset schedule and included as a note to the account. An example of this is shown below. So probably you might have learned the format like this. For example, see non-current assets. Let us say the assets are premises, plant and machinery, motor vehicle. So everything should be displayed. So it should be divided in two parts. One is cost part and one is depreciation part. In cost part, you have to show cost at the start of the year, revaluation, addition during the year, disposals during the year, cost at the end of the year. So total amount you have to say. This is the way you have to present it. So in the IAS said, this is the way. This is the very important format which you have to learn by heart, practice, whatever. So depreciation. Depreciation part you have to show what is the depreciation and the balance at the start of the year, revaluation undertaken, charges, depreciation charge during the year, disposals, everything must be disclosed. And net book value at the end of the year and net book value at the start of the year also should be disclosed. So this is the format. This is just an example. So this is the way you have to learn it, you have to practice it, and you have to learn it. It's very important. IAS 18 revenue. This statement is no longer in the syllabus. However, for the purpose of clarifying what is meant by the term revenue income statement is included here. Revenue is defined in the statements as gross inflows economic benefits arising from the ordinary activities of any entity. This means sales either of goods and services. It also includes income from interest, say bank interest, dividends received, and royalty received, and income non-revenue activities such as the process and the disposals of non-current assets. It does not include money collected by business on behalf of another party, say where the business actually benefits. However, any commission earned for collecting money as an agent is included as well. When a transaction takes place, the amount of revenue is usually decided by the government between the buyer and the seller. The amount of revenue measured will take into account any trade discount not being included as part of the revenue. The sale of goods is to be accounted for when all of the following criteria have been met. The seller of the goods is transferred to the buyer with significant reward of ownership. This is usually when the legal title to the goods transfer or possession of the goods policy is so that. This covers goods sold on a sale or return basis where the title has not been passed from seller to buyer. The seller retains no continual managerial involvement in and no effective control over the goods. The amount of revenue can be reliably measured. It is probable that the economic benefits will now flow to the seller. The costs incurred or to be incurred in respect of the transaction can be reliably measured. The sale of goods is to be accounted for when all of the following criteria have been met. So when the income is interest, the amount to be recognized is calculated using time basis matching concept. If the income is dividend, then these are brought into our income statement. When the shareholders' right to receive payment is established, dividend is received or brought into the account when the shareholders' right to receive payments is established. IS 23 borrowing cost. This statement is no longer in the syllabus. However, to illustrate what is meant by borrowing cost, how they fit with the finance costs shown in the income statement is included here. This covers such items in the accounts as interest on bank overdraft and how they remain in the income statement of the period for which they are incurred. A borrowing cost is interest and other costs incurred by business in connection with borrowing. This covers such things as bank loans or overdraft. The statement provides that borrowing costs are to be recognized and expensed in the income statement in the period in which they are incurred. An alternative to this is when the borrowing relates to acquisition, construction, or production of qualified asset. In this instance, the borrowing cost can be capitalized as part of the cost of the asset. For example, if an asset is being constructed and is financed by use of borrowed funds, then any interest payable on borrowing can also be amortized. Suppose a company borrows $10,000 to construct a new building. When the building is being constructed, any interest payable on $10,000 capitalized as part of the cost of the building. Once the building is completed, then any further interest payable on $10,000 is in the interest under finance. If any of the funds borrowed are temporarily invested in the short term and then generate interest, then this interest must be offset against the borrowing cost capital. Earnings per share. This statement is no longer in the syllabus. However, the calculation of earnings per share appears in the list of ratios to be examined. Hence, it's included here. There is a ratio. This is a ratio widely used by investors and analysts to measure the performance of business and is considered again in chapter 28. Chapter 28 deals with the ratio analysis. So, analysis of financial statements. The earnings of company are the profits or losses for the year that are attributable to the equity shareholders of the business. In other words, the profit for the year from the income statement less any dividends payable on non-redeemable preference shares. IS 33 sets out a basic method of calculating earnings per share, which is profit for the year minus non-redeemable preference share dividend divided by number of shares, ordinary shares, or divided by number of issued ordinary shares. As the non-redeemable preference shares are regarded as part of equity, any dividend payable to them will be adjusted in the statement of changes in equity. Published accounts, earnings per share are always shown in the income statement for both the current year and the previous year. They are always expressed in cents per share. Dividend on non-redeemable preference shares should be deducted from the profit attributable to equity shareholders before calculating the earnings per ordinary share. IAS 36 impairment of assets. The purpose of this standard is to ensure that the assets are shown in the statement of financial position at no more than their value or recoverable. The term recoverable amount means the value that the business can recover by one means or another from an asset. The formal definition is given below. If the recoverable amount is less than the amount of carrying, if the recoverable amount is less than the amount of assets shown in the account, its carrying amount, in effect its net book value, then the carrying amount must be reduced. This is an impairment as loss and must be recognized as an expense in the income statement. The standard applies to most non-current assets such as land and building, plant and machinery, motor vehicles, and so on. It also applies to intangible assets such as goodwill and investments. It does not apply to inventories, which are subject of their own standard IS. Some of the terms in their standard have already been covered in section 22.8 and IS 16. However, there are some other terms used in the accounting standard which require explanation. Amortization. This usually refers to writing down of an intangible assets such as impairment loss, the amount by which carrying amount of an asset exceeds its recoverable amount. Fair value less cost to sell, the amount obtainable from the sale of an asset in an arm's length transaction between knowledgeable willing parties less the cost of the disposal. Recoverable amount. In respect of the asset, the year of its fair value less cost to sell and its value increase. value in use. The present value of the future cash flows is obtainable as a result of an asset's continued use, including cash from its ultimate disposal. Useful life. This can be either the period of time which the asset is expected to be used by business, or the number of units are expected to be obtained with the asset. The impairment review. Businesses are expected to undertake an impairment review of their assets, and there is indication that this may be impaired because there is a reduced demand for the product may be made by a particular machinery or time. In other words, assess whether or not the asset's net book value in the financial statement is a fair representation of its true value to the business. The impairment review involves comparing the asset's carrying amount with the recoverable amount. It is carried out in 3 stages as follows. Stage 1, calculate the assets carrying amount, its net book value. Compare this with the assets recoverable amount. The recoverable amount will be higher of the assets fair value less the cost to sell. The assets value increase. This is the present value of future cash flows to the business generated as a result of using the asset. Stage 3, compare all values calculated. If either A or B is higher than the assets carrying amount, then there is no need to reduce the carrying value of the asset. However, if both are lower than the carrying value of the asset, then the carrying value must be reduced. Learn the way in which carrying value is compared with the greater of depreciation and cash flows in the asset, often called the asset value, and their fair value is less cost to sell. You may also be asked to write about what you have done. IAS 37, provisions, contingent assets and contingent liabilities. These items represent uncertainties at the time of the financial statements are prepared. They need to be fully accounted for on a consistent basis so that readers and users of the accounts can have a better understanding of their effect on the account. A provision can be defined as a liability of uncertain amount or timing. An example, how here would be provision for the cost of preparing goods that it has sold with long-term warranties, and where it knows from experience that at least some will break down. So provisions are only shown in the accounts when there are valid loans for them. They should never be used as way of input responsibilities. It is likely that the firm will have to make a payment for something, and the amount it will have to pay can be reasonably estimated. Then it can reasonably bring a provision into the accounts. On the other hand, a liability is a present obligation on a business. A present obligation a business has as a result of past loans, where its settlement amount is known and it is expected to result in payment being made. For example, a business has a liability to pay its suppliers for goods and services they have provided. There is another class of liability known as contingent liability. This is a possible liability to pay the business which arises from past years. However, it may result in the business having to pay for it only when a decision is made which is outside the company's control. For example, someone may be suing the company for faulty goods supply. There is a possibility the company will have to pay damages to the other party. However, the decision will be made by the court. This decision and the amount of payment is outside the company's control. A contingent liability is not recognized in the account but is disclosed way of note to them. This will describe the nature of the contingent liability. An estimate of how much it is likely to cost as an indication of the uncertainties relating to the amount of time outflow of funds. There is also a contingent asset which may affect a company. This is a possible asset arising from past events which will materialize when something happens which is not entirely within the company's control. The contingent asset should never be recognized in the account. So may be to bring in revenue that may never be realized. However, when the profit is almost certain to arise, it is no longer a contingent asset and it should then be recognized in the account. In other words, the accountant will include an amount which will be received. The IAS uses 3 words which talk about provisions, contingent asset and contingent liability. They are probable, more than 50% chance the event will occur. Possible, less than 50% chance the event will occur. Remote, little or no chance of the event occur. The following provides guidance of how items falling in these headings should be treated. Provisions more than 50% likely to happen probable. In this case, the amount should be entered in the financial statement. There must also be a note to the account giving details of these figures. Contingent liabilities less than 50% likely to happen probable. In this case, no amount is included in the financial statement, but a note to the account is given about the contingent liability. contingent liabilities which are remote, in other words, most unlikely to happen. In this case, no figures are shown in the accounts, neither is any note to the accounts. Contingent assets with more than 50% chance of occurring probable. In this case, no amount is included in the accounts. However, a note to the account is probable in the contingent asset. Contingent asset with less than 50% chance of occurring, both possible and remote. In both cases, no amount is included in the account. Neither is a note to the accounts included. So basically, a note is given. It is not recognized at all. Just a note is given. IS 38, intangible assets. An intangible asset is an identifiable non-monetary asset without a physical substance. The best example of an intangible asset is patent. However, patents and trademarks are also regarded as intangible assets. In other words, it is something which has value, but unlikely, say, plant and machinery cannot be touched. In terms of the definition given above, in order for it to be identifiable, the asset must be capable of being sold separately from other parts of it. As for instance, a customer could be an intangible asset. A customer list could be an intangible asset as it can be sold separately by the entity. In an instance such as this, the entity has control of the asset and its asset will also bring future economic benefits to the organization. Intangible assets can come from two sources. Firstly, they may be purchased. For instance, a business may buy the patents of a particular product from an entity. Alternatively, a business buys another at a figure in excess of the net book value of the assets they convert, then it purchases it. Alternatively, they are generated internally within the business. For instance, the goodwill which alternative, they are generated internally within the business. For example, the goodwill which is valued when a partner gives a business partnership or a new partner is introduced. In both cases, the goodwill has been internally generated by the partner. The general rule is that only purchased intangible assets are recognized in the account. The intangible asset is shown at cost plus any account with the amortization, depreciation, and impairment losses. An intangible asset of a type that is freely traded at a public market price must also be shown at a revalued amount, being its fair value CIS 36 impairment assets less any amortization of impairment losses. In this case, any loss in value is shown as an expense in the income statement. Any surplus is credited to the revaluation figure on the statement of financial position. In every case, the business must identify the usefulness of the intangible asset. In the case of those intangible assets having a finite life, they should be amortized using the straight line method. In this case, the residual value should be assumed as zero, and the amount of the amortization should be charged as an expense in the income statement. The amortization period should be reviewed at least annually, and any changes to the amount should be charged made in line with such a review. Where the asset is deemed to have an indefinite life, then it will not be amortized. Instead, accounting standard requires that it will undergo an annual impairment. Part of the review must also consider whether or not an indefinite life is still valid in respect of the asset. Any loss in value arising from such a review is charged on expense in the income statement. As an asset which has with an indefinite life will be written down. If at all by one or a series of irregular impairment charges. Whereas an asset with a definite life is not in predictable installment. The standard also provides guidance to business which can undertake research and development. In doing so, it provides definition of it. Research is theoretical work undertaken to gain new knowledge. This may or may not have some commercial benefit in the future. In this case, expenditure on research is to be written off as an expense in the income statement. Any non-current assets which are purchased as a result of research can be capitalized and written off over their expected useful lives. Development. Development is moving on a stage. It is perhaps using research to develop a product which is the business can use to generate sales at some point in the future. A good example here is the automotive industry where the research into green technology may result in the development of an emission in a car. In this case, development expenditure can be written off as an expense in the income statement. In the period in which it is occurred. Alternatively, the expenditure can be recognized as an intangible asset in the statement of financial position of the business. costing for materials, labor and overheads. How to start and finish studying. Have a bird's eye view and entire syllabus. Study this topic thoroughly. Work out examples, discussions and disciplines. Repeat your understanding until you understand. Practice exam questions. Practice. Never ever resort to shortcuts. Simulate exam conditions and patterns. In this lesson, we will learn everything about the nature and purpose of cost accounting, analyze costs into direct and indirect costs, methods of calculating cost wages, allocation and absorption of units, calculate over absorption rates, concept of over and under absorption units. All together, we discuss and practice questions based on these concepts. Identify the property of the purpose and nature of cost accounting. Cost accounting is one of the management tools included in a number of systems of accounting. Management accounting provides obtainable financial accounting as the way data is collected and more specifically presented. This section is completely different to the way it is collected and presented in financial accounting. Some larger businesses will have specific departments in the organization dedicated to cost and management. They provide a value addition to the organization. So far, for accounts in the company, we have been looking for this to. The financial statements are prepared up to the end of financial year. With cost and management accounting, the organization is gathering and affecting the performance of profit. All the information analyzed. There is also some overlap with financial accounting, particularly the long-term part completed units of product will allow to accurately value the financial statements. Direct and indirect costs. So 20.2 solved at the direct costs include direct material, the material from which goods are made and carried in the direct labor, the wages of workers actually goods and direct expenses, royalties, licensing, and so on. Indirect costs on the other hand are indirect material purchased for the fabrication of material. Clean materials are lubricating indirect wages purchased from factory managers, supervisors, stores, and so on. And other overhead costs, rent, heating, and lighting. This distinction is very important for cost purpose. It is important that you are able to classify costs this way. The behavior of costs. Direct costs are linked to vary in proportion to the number of producers. They may sometimes be called for example, the quantity of material is required for the production, location of the required for the quantity for maintenance and so on. Will be true for royalties and other direct expenses. The royalty and paid to the personal company using the product has to be paid for every unit produced. The royalties payable will always be the number of times. At one time, it may have been common for direct workers to be paid according to the amount of workers. So the direct will be approached throughout. This wage may or may not be supplemented by product necessary. In fact, therefore, this will be direct as in proportion to the product. Direct costs and fixed costs are costs they are fixed if they are not fixed. Direct to the level of activity. Let me take an example of this. Straight line depreciation and expenses. However, it is important to remember that the expenses are actually and that will increase the total depreciation. The products basically still further and more machines can have been it may be necessary to lease more factory space and this cost will become certain cost and may be represented by a charge as follows. So this is the fixed cost and these are fixed cost because they are increasing over a period of time. At A, it has been necessary to buy an additional machine in order to increase the production and the depreciation. At B, A further machine has been bought and it might be necessary to rent additional factory space for the depreciation charge and the rent has been considered. Looking at the fixed cost line, it moves upward at both points. A and whole, making the whole line look like steps. Hence, step to fixed cost. So, step fixed cost means the fixed cost which keeps on increasing with the increasing level of with the level of activity. Above this level of activity and with above this is cost. Recording materials, labor and overheads. Consequently, because materials consists is classified as direct or indirect, the general materials is definitely organized as part of the finished product. They are regarded as direct materials. For example, in the manufacturing the content is subject boards and some cases will be regarded as direct materials. The cost can be traced directly to the product being produced, hence direct cost. Consequently, the name given to the input product is really the output is the cost. You would refer to the one set case, you would simply and the direct material cost per unit. The business issue is close to its workers to ensure no dust or pollution goes into the finished product. The cost of this material is rather indirect. They can be used as a number of times during the manufacturing process. In this case, the cost of pair of gloves is not taken as a direct material cost. The total cost of all indirect materials are added together and they are then charged to each cost unit on a predetermined basis. This is covered in the next chapter. Cost accounting requires both material purchase and its be classified as direct or indirect. If expenditure has been incurred for particular department, it will be analyzed by department and services will be quoted in purchase department to show the type of expenditure. The purchase journal must have additional columns so that the expenditure can be analyzed according to the cost on the invoice. Wages are analyzed into different departments and then classified into direct and indirect wages on payroll. If the systems of analysis of have been carried out, all expenses can be posted in the ledger for public account to enable the allocation of certain cost centers as described in section 28.10. Direct and indirect materials. Manufacturing business may hold a number of different items which are used according to market demand over time and the significant income the business being primary. This causes a number of problems with the addition of such materials. Section 32.5 the value of business. When considering manufacturing property means to allow two different manufacturing for value direct materials. They are first in, first out. This assumes that the first item should be bought in the first two items, although this thus, remaining inventory valuation will always be value on the first case. So, we will be working out practical problems based on this. Average variable cost, average cost. Under this method, any average variable value, including the weighted average, in a very few cases, it may be possible to value good for the price actually paid for the odd. For example, the owner of an art gallery may be able to say that from art she bought each of the pictures regularly and how much she paid for it. Because there will be probably a limited number of printing that she will be able to recall how much she paid for it. The manufacturer of computers, however, not many people to show how much he paid for the parts he used for the computers. Purchases of hard drives, for example, will be generally equal and made at different times on the different prices. It will be impossible to say at the year how much has been paid according to the given hard drive. The problem is solved by assuming that inventory is occurring in particular pattern. That is not strict, so it is often called a confusion. Sometimes something that is urgent may happen is not this all. Value material before. As we have seen under this materials are the order in they are received from the supplier. So we will be looking out and you will not understand this unless problems are actually working. Value inventory is now unlike before, no priority is included before value of the weighted average cost of this this process is extremely important to common state listed by the value of inputs. Perpetual and periodic inventories. Inventory is a record of supply and use of the The examples for the compound value. So a periodic ratio is the balance of the the effect of method of definitive value this is the statement of the problem. If you are now compare, it is important to compare that with the result of this. It is a relatively simple system. Especially if they are question. Prices will be both that are actually like current price values. People will and accounting standards. Disadvantages. But before we do analytical literacy. Where from job? The customer provides job. Types of price. Our is different. Advantages of average rates of identical analytical values. Average values are true average cost average cost reduction cost and comparison. Average this one is directed either method neither does other method of valuation such as green research always rather than value such as direct and the possibility responsible the wages could be raised. In addition to the advantages to the disadvantages to at the expense of quality proportion cost. Cost increment is cost increment. Cost increment production cost increase and directly holding machine cost. Service percentage and holding allocation and apportion of cost. Direct expenses. Overhead expenses. Overheads metal, plastic chemicals, components and production development, sometimes they will be regarded as direct lubricating maintenance of other overhead are approached for the business generally and they are approached to cost apportion purpose. Overheads are basis of apportion. So overheads heating and lighting is not separately to the cost. Rent, insurance, are apportioned the basis of the respective floor areas of the department. However, if you are separately to cost of actual calculation is allocation of insurance of plant, machinery and other assets on cost of replacement values of assets. Depreciation of non-current assets on the cost of value of assets. When calculating the overhead subsumption, apportion to each department, the answer is around the figures of down but always apportionment of service cost and total of cost spread with all over the basis usually adopted of service cost are divided into stores. The cost of stores is divided among number of value of store locations and production cost. And the number of customers are apportioned. The basis of area occupied by production cost. Land and machine maintenance is apportioned on the basis of number of value. However, records of actual increase cost the cost of the account. There are a number of ways of measuring cost increase under the orders and production cost. They all interlinked for very small detail. The simplest and quickest is the records. It is not necessary to apportion the overhead of service department to the cost of the service department cost of the if as this is the case, there is more than one service cost to the more steps to the last service cost to the how to allocate overhead consumption. Once overheads have been apportioned to cost, the step is the calculate overhead are being cost inside passenger vehicle transport electricity generation. Overhead apportionment rates are calculated cost of allocations of volumes of cost of about the disclosure this time is measured either in direct labor over overhead absorption cost the labor cost the following is protocol divided by the decision of is so direct the last one. Hospital is likely to see purposes for the hospital. Directly. Or it always make sure it will be correct. As we have seen, some of the each unit is now possible to see having calculated the class to state this can be added to get calculated the maximum cost of some business will also add a percentage. We'll also notice that we have the 50%. The selling and distribution aspects, for example, now the capital cost is wherever the quantity is the addition of some this case and rather to the quantity cost becomes it is quite common to see a company only a certain amount of avoiding E. Prepare the calculation other bases of calculating the following basis for calculating direct profit for overhead of direct level of the labor cost the highly the same time. When for this method combined the decided cost this method is restricted to the there are overhead explain overhead of and actually there are and a production more of the actual expenditure is and a production and actual production is the plant. This is to you learn from the definitions of cost. Practice calculation. Learn how to calculate under absorption and over absorption. Check calculations, check calculations. This is an important chapter as it takes aspects and our calculation. final topic we have learned about the chapter in this chapter is government and we should now begin with the how to allocate the information and how to calculate the cost. So yeah, the cause of financial accounting is the calculations. Many of the terms used in this chapter will be surface cost and the definitions. Take some time to read all these elements subject to understand. Unit job and batch costing. How to start and finish study. Have a bird's eye view of the entire syllabus. Study each topic thoroughly. Never ever resort to start first study. Work out examples, illustrations, and exercises. Repeat until you understand. Practice exam questions. Practice mock exams. Simulate exam conditions and practice. Unit job and batch costing. In this chapter, we will learn the difference between continuous and specific order operations, what unit costing is, what job costing is, what batch costing is, how to prepare a quotation for a job. Continuous and specific order operations. Costing systems may apply to every type of business, including public or privately owned organizations, manufacturers of goods such as motor cars, breakfast cereals, providers of services, example hospitals, hotels, restaurants, lawyers, and hotels. Each type of business must choose a costing system that suits its particular operation. No one system will serve every type of business. The operations of a business may be classified as either continuous or specific order. Continuous operations are typically those in which a single type of good is produced and the cost units are identical. Production involves a sequence of continuous or repetitive operations. Examples are manufacture of computers, production of mineral water, oil refining, production of medicines, passenger and freight transport. Continuous operations will almost certainly involve a product passing through a number of processes or different operations. For example, when making steel, the raw material will pass through a furnace, then be rolled out in sheets of metal and then cut to size. The final product would probably then be packed before being sent to customers. Specific order operations are those which are performed in response to special orders received from customers and may be classified according to whether the operations consist of individual job or the production of batches or identical units of it for a customer. Continuous costing. For a business with continuous operations, continuous costing is used to find out the cost of single unit of production or service. Unit costing. A single unit can be a single item, but a manufacturer of large volume of single product may find it more convenient to regard a number of items as single unit. For example, a company producing hundreds of thousands of packets of breakfast cereal, the unit may say 1000 packets. Other examples of cost units are pallet of bricks in brick making. A pallet is wooden platform on which a given number of bricks is stacked up after manufacture, and barrels for the output of oil wells. Specific order costing, job costing. For a company with specific order for operations, that is, those which are performed in response to special orders received from customers. Job costing can be carried out. Each order becomes a cost unit and can be costed at a separate job. Examples of jobs are repainting a house, repairing a television, servicing it. This is one of the crucial advantages of cost accounting over financial accounting. As the costs have been classified for the job, the directors can focus on specific areas. In the financial account, these costs will be lost in almost among all other labor and overhead, giving the directors limited opportunities to analyze the cause of any differences or plan for the future. Batch costing. Batch costing is very similar to job costing and is applied when an order for a customer involves the production of a number of identical items. All the costs incurred are charged to the batch, and the cost per unit is found by dividing the cost of the batch by the number of units in the batch. You must be able to calculate a price to quote for a specific order. This was covered in section 28.11 and is again covered again here. This is a short chapter but nonetheless very important one. You should be familiar with the different types of costing involved in the definition of the unit cost and batch costing. And you should understand the difference between continuous and specific order operation. Finally, you should be able to apply your understanding of these topics to prepare a quotation for result. Look back at section 28.11 and this chapter to make sure that you are able to work out something asked in a question. As always, with questions on costing, there is no set format to set out your answer unlike financial accounting. There are some formats presented which may help, however, you set your answer, make sure it is clearly labeled and that all workings are shown. Marginal costing. How to start and finish studying. Have a bird's eye view of the entire syllabus. Study each topic thoroughly. Never ever resort to shortcuts in study. Work out examples, illustrations, and exercises. Repeat until you understand. Practice exam questions. Practice mock exams. Simulate exam conditions and practice. Marginal costing. In this lesson, we learn everything about what marginal costing is, how it is used, concept of contributions and the contribution to sales ratio, concept of break-even point, break-even chart, application of marginal cost in pricing policy and deciding price, decide whether to make, sell or buy from outsiders. Altogether, we discuss and practice questions based on these concepts, identify and work out examination problems. Marginal cost. In chapter 29, we saw how total costing can be used to determine price and profit, but beyond that, it is can be limited. In chapter 28, we identify classification of cost as fixed or variable. In this chapter, the distinction between them is important. The distinction is that variable costs increase in direct proportion to changes in the level of output. Within a certain range, fixed costs remain unchanged as output increases or decreases. For many management decisions, it is necessary to know the marginal cost of the unit of production. Marginal cost can be described as the cost of making one extra unit of an item. It is based on the principle that an additional unit of production will only result in an increase in the variable cost and that the fixed cost will not be affected. Marginal cost of production is therefore the total of variable cost of production. Remember that both terms relate to the same thing. This is called a contribution because it is the contribution that each unit of the production makes towards covering the overheads and providing a profit. Marginal cost, the cost of making an extra unit of output. Contribution, the difference between the selling price and variable cost of the unit or unit of output. In total, it is also the difference between the total revenue and total variable cost. See, in marginal costing, we prepare a cost sheet like this: variable costs, which will be direct material, direct labor, direct expenses that will lead to the end cost. So to that, when you add variable overheads, you get marginal cost of production. So when you add fixed overheads to that, you get total cost of production. And when you add profit to that, that will give selling price. So what is contribution? Contribution is nothing but selling price minus marginal cost of production. So that is what is contribution. In other words, fixed cost is excluded to find contribution. The contribution per unit is calculated as follows: selling price per unit plus the total of the variable cost per unit. The calculation of contribution either in total or per unit is an important aspect of marginal costing. I am sure that you are fully aware of what it is. Contribution to sales ratio. This is also known as PVR ratio. This ratio of the contribution to the selling price is known as the contribution to sales ratio. This is very useful ratio that can be used to calculate the answers to many problems. The use of CS, contribution to sales ratio, avoids the need to spend valuable time calculating marginal cost. The break-even point, the point at which a business or a product makes neither a profit nor loss is the break-even point. Managers need to know the break-even point of a product when making decisions about pricing, production levels, and other matters. Break-even occurs when total contribution equals total fixed cost, or alternatively, and total revenue minus total variable or margin cost equals fixed cost. It is found by dividing the total fixed cost by the contribution per unit. The calculation gives the number of units that have to be produced and sold before the fixed costs are covered. When the calculation of a break-even point results in the fraction of a unit of production, the answer should always be rounded up to the next complete unit. For example, so 32,000 divided by 23, 1391.304. You have to round it up to 1392, not 1391, because a product cannot be a fraction. So it should be always the next number. Always indicate whether the break-even figure you have calculated is in dollars or units. The formula of selling price minus variable cost can also be extended to calculate how many units need to be sold to earn a required level of profit. Break-even chart. A break-even chart is a dynamic representation of the profit or loss to be expected from the sale of a product at various levels of activity. The chart is prepared by plotting the revenue from the sale of various volumes of product against the total cost of production. The break-even point occurs where the sales line touches the total cost line where there is neither profit nor loss. Suppose the marginal cost of a product is $10 per liter. It is sold at for 22.5 per liter. Fixed costs are $50,000. This can be shown using a break-even chart as follows. So across this is the revenue, is the amount. Across this is the quantity, output in units. So across this you can see there is margin of safety, fixed cost, revenue, profit, everything. So the break-even point is where the revenue and total cost line intersect. The break-even point, this is the point. The line AB shows, the line AB shows the revenue at break-even point, 50,000. So this is the break-even point. This is the break-even point, and it is on the line BC shows the output unit. BC shows the output unit. So this is the quantity at which there is a break-even. So beyond this is margin of safety. This is margin of safety. This is margin of safety. So this is the output units at break-even point. At 10,000 units, the revenue is 2,25,000, 225,000, 225,000, and total cost is 150,000, 150,000. The distance between those two lines shows a profit of $75,000, $75,000 the distance. So the difference between the revenue line and the total cost line before the break-even point represents the loss that will be made to the output cost below 4,000. Below 4,000, this is the loss. So the area beyond the break-even point represents profitable level of sales. Beyond the cost is profitable level of sales. Level of sales. The difference between the break-even point and 10,000 units is the margin of safety. Difference between this and this is margin of safety. So, or the amount maybe the output can fall short of 10,000 before the business is making a loss on product. It may be expressed a number of units, 6,000 or as a percentage of 60%. 60%. Margin of safety is 60%. Profit volume charts. Break-even charts may also be drawn to show only the profit or loss at each level of output. The cost and revenue lines are omitted. The break-even chart for product is given in the example above could be drawn as a profit or volume chart. Profit volume chart for product is zero output, the loss equals the total of the fixed cost, $50,000, and 10,000 is the profit is equal to $75,000. A straight line joining 2 points intersect the output line at the break-even point. Make sure that if you are asked to prepare a break-even chart, you don't prepare a profit volume chart or vice versa. The limitations of break-even charts. Break-even charts are useful visual aids for the study of the effect of changes in input cost and revenues on the break-even point, especially for managers with detailed accounting knowledge. The charts, however, have their limitations. It is important that you know the limitations of break-even chart. Try to learn them thoroughly. If revenue and costs are represented by straight lines, they may be misleading. Minimum revenue may also be achieved if customers are given attractive discounts, while variable costs may be affected by quantity discounts when output is increased. These factors would be more accurately represented on charts by cost rather than the straight line. Some costs may be semi-variable. In other words, there is both an element of fixed cost and an element of variable cost included in the cost in the total. An example of this is the telephone. The fixed element may be the line rental which must be paid whether any calls are made or not. The variable element would be the call charges which will increase each time a call is made in order to break it to work. The fixed and variable element must be calculated and added and with the appropriate figure. The charge can mislead people whose accounting knowledge is limited, but trained accountants will know how when to make allowances for a charge limited. Many fixed costs are fixed only when certain limits and may increase with the level of activity. They are strict costs or semi-variable costs. In order to prepare a break-even chart or work out the break-even point, it is essential to use only fixed and variable. Sometimes you may not be specifically told that certain costs are semi-variable, where for two different levels of output, the other costs have two different values in total and per unit. Marginal costing and pricing. The price at which a good may be sold is usually decided by a number of factors. The need to make a profit, market demand, a requirement to increase market share for a product, maximum utilization of resources, competition from other firms, economic conditions, political factors, price regulation, and so on. Marginal costing can help management to decide on pricing policy, but first it is necessary to understand that some expenses, such as selling expenses, may be variable. An example is sales totals commissions based on the number of units sold. When variable selling expenses are included in marginal cost, the result is the marginal cost of sales. So you can see direct material, direct wages, direct expenses, that will be marginal cost of production. Variable selling expenses will be marginal cost of sales. Other fixed expenses will be total. It is important to use the correct marginal cost when using marginal costing for decision. Acceptance or order below normal selling price. There are occasions when orders may be accepted below the normal selling price. Then when you consider when there is a spare manufacturing capacity and in the following circumstances, and the order will result in further contribution to cover fixed expenses and add to profit, to maintain production and avoid laying of skilled workers during a period of trading to promote a new product, to dispose of flowing or redundant inventory. The rule is that the selling price must always exceed the margin cost of production in president. Then each unit will be sold at a loss before taking fixed cost into account. Acceptance of orders below normal selling price. There are certain occasions when orders can be accepted below the normal selling price. These may be considered when there is a spare manufacturing capacity and in the following circumstances. When the order will result in further contribution to cover fixed expenses and add to profit, to maintain production and avoid laying off skilled workers during a period of poor trading, to promote a new product, to dispose of slow or redundant inventory. The rule is that the selling price must always exceed the margin cost of production. If it doesn't, then each unit will be sold at a loss before taking fixed cost into account. Fixed expenses will not be affected with additional production. If you are told that fixed cost will also change, remember to take this into account in your calculation. The question here is whether the order should be accepted, either you should accept either of the orders. Make or buy decision. We already seen in chapter 20 that the manufacturing account is that it should be to be more profitable for a business to buy goods from another supplier than make the goods itself. This involves make or buy decision. It may be relevant for the goods that are already being produced or the introduction of a new product. The decision will be based primarily on whether the cost of buying the goods from another supplier is more or less than the margin cost of production. Notice that the margin cost of sales is not relevant to this type of decision, as any variable selling cost will have to be incurred when the goods are manufactured or purchased. The principle in this situation is that if margin cost of production is below the price quoted to the supplier, then the offer should be rejected. Making the most profitable use of limited resources. Anything which limits the quantity of goods that a business may produce is known as limiting factor. Limiting factors include shortage of material, shortage of labor, shortage of demand for a particular product. When faced with limited resources, a company making several different products will use the limited resources in a way that produces the most profit. In a previous decision, the contribution per unit has been an important factor in making the decision. However, when making the best use of limited resources, the product must be ranked according to the amount of contribution they make from each unit of the scarce resource. Production will then be planned to ensure that the scarce resource is concentrated on the highest point. You may be asked to calculate the profit if there is no shortage of material and then divide profit taking into account the shortage of material. Seizing the manufacture of a product. Another important topic and one which margin costing is important is the decision whether or not to cease producing a product. Sensitivity analysis. Section 30.3 says the sensitivity of contribution cost break-even points to change in cost and revenue was mentioned. This topic will not be covered in more detail as results in estimates of revenue cost will affect profit. By definition, estimates are rarely likely to be accurate and allowances should be made in budget for possible differences between estimates and actual cost and revenue. The point will be illustrated by taking the example of a high-risk situation. Marginal cost versus absorption cost and inventory valuation. When we look at FIFO and average cost, we saw that any difference in value including inventory will produce different profits because the two methods of costing margin and absorption will also produce totally different profits as the closing inventory is valued in two different ways. Advantages and disadvantages of marginal costing. Using marginal costing has both advantages and disadvantages. They are separate below. Advantages of marginal costing. The technique is easily understood. The reason is that fixed costs are not included in the cost of production and there is no arbitrary apportion to fixed costs. Contribution provides a reliable measure for short-term decision. Marginal costing shows clearly the impact on profit of fluctuations in the volume of sales. Under absorption, over absorption, overheads are not a problem and there is no need to calculate overhead. The marginal costing technique can be used with ceramic costing. The technique shows the relative contribution to profit that are made by each product and shows where the sales effort should be contracted. Disadvantages of margin costing. The disadvantages of margin costing are perhaps the biggest disadvantage of margin costing is that only useful for short-term decision making. Not all costs can easily be split into fixed cost and variable cost. Under margin costing, the fixed cost remains constant and variable cost vary according to the level of activity. In reality, the fixed cost does not remain constant and variable costs do not vary according to the level of activity. In the long run, all costs are variable. In the case of loss by fire, if inventory is valued using margin cost, the full amount of loss cannot be recovered from the insurance company since no element of actually fixed overhead is included. A management should not base decisions using contribution alone. The contribution may vary if new techniques are followed in production process. Leading on from this, the technique assumes that the production method will remain constant. In practice, this is not the case. Investment in new machinery at the expense of reducing labor will bring the cost structure activity. It is really only useful or for a business which makes a single product. A company making several products will have a difficulty with allocating fixed cost to each product and with immediate security. So this will make it difficult to capture the break-even point for either a single product or the business as a whole. On balance, it may seem that the disadvantage of margin costing are greater than the advantages. As we have seen, though, margin costing is widely used for short-term decision making. This chapter has covered the basics of margin costing, including what margin costing, how is it used, including how to decide on pricing policy for make or buy decisions, and determining how much to make the most profitable use of scarce resources. The concept of break-even is an important one for business, and in this chapter we have learned not only what it is, but how to calculate it and how to prepare a break-even chart. You have to learn. You have to learn about the importance of contribution and contribution to sales ratio, the use of calculation of sensitivity analysis, how to value inventories and obsolescence. You should also learn what happens when orders from customers are accepted below the normal sales price. Once again, there is no set layout when answering questions in this topic. Try to use tables for the answer. Setting things out in ways used in this chapter. Always make sure you fully label everything and show all your entries. It is an important topic area, so pay careful attention to it and work logically through practice questions.
Dear friends, welcome back to Shasha's virtual classroom. So today we'll be doing practice exercises from credit transactions. And this is from David Hopkins. Suppose the following transactions in the books of Gerard. Okay, so if it helps, write down the names of accounts. So if it helps, write down the names. These are tips. Okay, so these are the tips. So write down the names of accounts you should debit or credit before you start posting the transactions to them. Work out the amounts of trade and cash discounts before you post them to their correct accounts. So first, let us calculate the amounts. So trade discount, purchase goods from car which cost $3,000 less trade discount of 10%. So 3,000 minus 10% is $2,700. So then sold goods to $600. It will be like that only. So return goods which had cost Berod 200 less discount to car. So 200 less discount. So it was you had sold here, right? So car. So you had sold here. Now, so it is being returned. So 20,000 200 less 10% is $180. 200 minus 10% is 180. So purchase goods on which cost 200 before trade discount of 10%. So before trade discount of 10% means so again it will be $2,800 minus 10%. $2,800 minus 10% is minus 280. 2,800 minus 10%, 2520. So it's 2520. So trade discount is never recorded. Remember that. So trade discount is never recorded. So it is 2520. Sold goods switch in for 1,300. So no discount here. Law return goods which had cost him $200 less. So this is lie. We have sold for 600.
lie return goods which cost him $200 less discount. We did give lie any discount. So have we given any discount to lie? No. So then this will be as it is. So $200 only. So there is no discount. It was not given. So it will not be given again. So it will never be given. So even though the question says like that, but we are not supposed to suppose, because here they are not mentioned whether we have given them any trade discount. Or it may be that there is a mistake, printing mistake. So if that is the case, then less, because everywhere it's 10% trade discount. So let us consider it's 10% trade discount. It will be $540. So which we should record. So here it will be lie return which it costs 200. So minus 10% will be $180. Then Gerard paid Kaur and Lim the amounts due to them after deducting 5% cash discount. See, so many big calculations are there. Lai and Chin paid Gerard the amount they owed him after deducting 5% cash discount. So again you have to calculate. So how do you calculate? So wait, let us see how to calculate. Okay, so there is space here, so we'll write down. So Gerard, okay, so Gerard. These are the books of Gerard only, right? These are the books of Gerard. Gerard paid Kaur. So we are paying to Kaur. So remember, whose books? Gerard books. Gerard will never come. So Kaur and Lim. Okay, Kaur, how much we have to pay? Kaur we have sold 2700 minus we have returned. He has returned 27180. So 2700 minus 180 is equal to 2520. 2520 we have to pay minus 5% cash discount. So this will be recorded. So this is cash discount. We recorded. So that will be how much? Minus 5%. Be 2394. 23. What is cash discount? Cash discount is 2520 5%. 5% 126. 2520 minus 126 is equal to 239. Now core is over. So now lie. Sold goods to lie 600. Sold goods to lie. Core and limb. So limb, again here limb. Core and limb you are paying. So limb you write here. Lie you write here. And who is the other one? Chin. lie 600. How much has been returned? Lie 200. So 540 minus 180. 540 minus 180 is equal to minus 180 is 360 minus 5%. 5% is cash discount again. Cash discount. So that is equal to 360 minus 18. 18 is cash discount. So the net amount payable will be 340. 340. Okay, then core and lie and chin paid Gerard. Lie and chin. Okay, so now limb. 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 So limb. Where is limb? Core over, lie over, core over, limb. Limb is 2800, that is 2520. So are we returning anything? Rim, is limb returning anything? Are we returning anything to limb? No, we are not returning. So 2520 minus 5%. So that is equal to 2520 into 5%. 126. 2520 minus 126, which is cash discount again. Cash discount. So that is equal to 239. 2394. Again same thing. Chin. So now chin. Where is chin? Chin is here. Sold goods to chin. So chin has not returned any goods. Okay, chin has not returned any goods. Only lie returned. Only there are purchase returns. We have returned to Mr. Gerard has returned to CA. Returned goods. Okay, so here you can see returned goods which had cost Gerard rupees, Gerard $200. Lie returned goods which had cost him 200. Lie. We are purchasing. Okay, so there is one sales return and one is purchase return. Okay. Chin. There is no return by chin. Sold goods to chin means there is no return by chin. So 1300 minus 5%. So that is nothing but 1300 minus 1300 minus 5%. $65. $1, 1, 2, 3. See, these are the calculations. So that is why it is advised that first when you work out the trade and cash discounts before you post them to their correct accounts. So first, these are so many calculations. See, so many different calculations were there. Though this looks simple, some students make mistakes even in calculating this. So be careful. So then now we'll come to the main part. So which account will be debited by how much, and which account will be credited by how much. So debit, credit. Okay, so purchase goods from car, which cost 300 less trade discount 100. So we are purchasing from car. So Gerard is purchasing from car. So purchases account will be debited. Account will be debited. Car account will be credited. Car account will be credited. So why car account will be credited? Because car is giving the goods. He is the person who is giving. Okay. So when Gerard purchased, car gave the goods. He is the person who is giving. This is the account that is giving the goods. Okay. So that's why his account will be credited. So amount will be 2700. Amount will be 2700. Same line. Okay. See. So now sold goods to lie for $600 less 10% trade discount. Trade discount. So 540. So sold goods. So sales account. Sales is an income always. And who is receiving the goods? Lie is receiving the goods. So lie account debit. Because he is receiving. Lie account will be receiving. So that is why his account will be debited and sales account will be credited. Sales account will be credited. Return goods which had cost Gerard 200 less discount to car. So return goods which had cost Gerard. So this is who is returning? Gerard is returning. So it is purchase return. So obviously when he returns, it will be purchase returns. So purchase returns will be exactly reverse of purchases. So purchase returns. Purchase returns. So how much? It is returned to car. So car is receiving the goods. No. When you are returning back the goods, car is receiving the goods. So he is receiving it. Car account. Car account should be debited. So then, purchase goods from Lim which had cost 2800 before trade discount of 10%. So purchase goods from Lim. So purchase goods from Lim means purchase. Again, purchases is always purchases. Purchases account. Purchases are always purchases. So purchase account. Goods from Lim. So who is giving the goods? So Lim is giving the goods. So Lim account is created because Lim is giving the goods. Okay. Sold goods to Chin for $1300. Sold goods to Chin for $1300. Sold goods to Chin. So Chin is receiving the goods. Chin is receiving the goods. Chin account debited. Sales account credited for this. So Lai returned goods which had cost him $200 less discount. Lie return means this is you have sold to Lie. No? Just here it you have sold to Lie and is returning the goods. Maybe they are defective. That's why Lie is returned. So Lie is giving. So you have to give, you have to credit whoever gives, right? So Lie account will be credited. And it is sales return. Sales return is reverse of sales. So it is debit. Sales return account. So then this is also done. Then now
लाइसेंस खुले नहीं करते ना अभी.
So this is also over. So this is for this.
ये भाई.
Gerard paid car and linked the amount due to them after deducting 5% cash discount. So when you are making when Gerard is making the payment, who will receive? Car will receive. So car will receive. Car account and lim also will receive. Lim account. Car account, debit and credit toward bank account. Bank account. But one more thing is there. What is that? Discount account is also there. Gerard paid car. So when Gerard is paying car, he is not paying certain amount. So which is cash discount. So it is discount received. So it's an income. So discount received will be credited. For car it will be 126. Okay. Car it will be 126 and lim it will be again here also discount will come. Discount received will come. So here also it's 126. Both for car and lim discount received is 126. So bank account will be how much? Bank account will be 2394. What will be the amount? 2520. 2520 here also. 2520 here also. Car and lim. Car and lim. Or how much you have to debit? Or you have to debit 2700. What is the discount? No, correct one. 2520. So this is trade discount. Trade discount will never be recorded. Trade discount will never be recorded. So it will be recorded in this. This will be recorded in this.
Hello? ಯಾರು ಇದು? ಇಲ್ಲ ಯಾರಿದು?
Then Lion Chin paid. So Lion Chin paid means obviously money will come into bank. Bank account will be debited. Bank account will be debited. So Lai pays how much? Lai pays 342. Lai pays 342. We receive 342. So Lai account. Lai. And when we pay, when we are receiving lesser than. So here there is no discount for lim. Lim. Lai return. Goods which should cost 200 less. Trade discount. Okay. Lai. $342 we are receiving. So bank and discount received. Discount received is, it's not discount received, it's discount allowed, it's an expense. So when you pay short, it is expense. Discount allowed is like 80. So here it is 360. liable 360. So bank account. So here in this case it is 1235. So discount allowed is 65. Discount allowed is 65. So chin will be created with this plus this. So that is 39. So now you have to prepare ledger accounts and post the amounts. Prepare ledger accounts and post the amounts. So start doing this. So it's very simple. So we already done this. So you can do the rest of the part. So if required, we can do it in the next class. So dear friends, last class I had given this assignment to you. This is assignment from David Hopkins. So this is very challenging because in this your concept of books of accounts of particular person is very much important. So accounts of one particular person is very important. Post the following transactions in the books of both Brian and Ken. See what is if for Brian the transactions will be different. For Ken the transactions will be different. Because if he is buyer, he is a seller, and if he is a seller, he is a buyer. So here it has been asked name of accounts to be debited, name of accounts to be credited. So you should not get confused. You should not get get it wrong. So you are not so see if you write books of, but here the question is you have to post the transactions in the books of both Brian and Ken. But here they have asked you to write name of account to be debited, name of account to be credited. But whose books? Is this whatever you are writing here, are these related to Brian or are these related to Ken? So what is the best remedy? Let us for the time being we will consider this as the books of Brian.
Yeah, same day we did.
And for Ken, we will write separately.
Okay.
Okay, books of Brian.
Okay.
So what is Brian doing? We have to see from the point of view. So Brian sold goods. He is selling the goods. So it is sales for him. For Brian it sales, and for Ken it is purchases. So when Brian sells, who will receive? Who is receiving? Ken is receiving. Ken is receiving. And when Ken is purchasing, who is giving? Brian is giving. So this concept should be very clear. Now, Ken sold goods to Brian. So sold goods to Brian. So sold goods to Brian means what is Brian doing? Brian is purchasing. Brian is purchasing. So it is purchases because these are the books of Brian, right? So you have to write it in the books of Brian. So it is purchases for. So if Brian is purchasing, who is giving the goods? Ken is giving. If for Brian if it is purchases, then for Ken it is sales. And the other side, it is Brian. So the understanding should be very clear, crystal clear. So don't get confused. Brian sold goods to Ken. Again, sales. Sales. So again it is Ken who is receiving. So if it is sales for him, it will be purchases for this. So here it will be Brian. Then Ken sold goods to Brian, means Brian has purchased. So then Ken. If it is purchases for him it will be sales. So if it is sales this side, then who is receiving? Brian. Ken paid Brian for the goods he bought on. Ken paid Brian. So Brian is receiving money. Is receiving cash. And he is allowing discount because it is a loss. He is receiving less. Then who is giving? So obviously Ken is giving. When Brian is receiving, Ken is giving. So now Ken paid, no, simply, that's all. So cash. Cash is going. And he is paying less. So if he pays less, it is discounted received. So it is an income. And to whom? To Brian. Brian paid Ken for the goods he had bought on 2nd April, let's say cash. So now Ben is paying. Brian has paid. So cash. So he has paid less discount. So it is Ken discount. So here if it is discount received for him, here it will be cash and discount allowed. And here it will be. So after doing this, you have to prepare the ledger accounts. Ledger accounts of Brian separately and Ken separately. So purchase account, how many ledger accounts will there? Purchase account, sales account, Ken account, discount received, cash account, all these accounts will come in this. And in this, so many accounts will come. So, we'll prepare the ledger accounts. Shall we prepare the ledger accounts? I will give it as an assignment to you, so you can try on your own. So let me see, and I will discuss this in the next class. Here friends, last class we had discussed this problem. So you can see still on the screen, so it is as it is. So we will now enter the following, prepare ledger accounts for dispose the following transaction in the books of both Brian and Ken. So we will post the entries to ledger accounts of Brian and Ken. So how to do? So we will proceed. So books of Brian. Okay, so books of Brian. So first we will complete books of Brian. So Ken will be debited with sales. First entry, Ken will be debited with sales. Ken will be debited with sales. Ken will be debited with sales. So sales. Ken will be debited with sales. So what is the amount? Let us see. So the amount is 1500 and date is April 1. This 1500. Okay. So next, next one, credit can with purchases. Credit can with purchases. Credit can with purchases. Can with purchases. So what is the amount? So the amount is 500 less trade discount of 200. So 520% is 400. And that is on April 2nd. April 2nd, 400. So, and purchases will be debited with K. So now next, brand can debit can with sales. So 800 less 25% trade discount. So 600 debit can with sales. Debit can with sales. So it's 600. So what date? Third April. So can you debit it? So what about sales? Sales also you have to accordingly you have to credit sales. Okay, next. Again, credit can with purchases. Again, credit can with purchases. Again, credit can with purchases. So, what is the date and amount? 920%. 6th. Okay. 6th. And then 720. So purchases you have to debit again. So again. Okay, next. Now, can pay Brian for the goods bought on 1st April less in cash discount of 3%. So, credit can with cash and discount alone. Credit can with cash and discount. Credit can with cash and discount. Cash and discount alone. So, credit can with cash and discount alone. How much? For goods you bought on 1st April. He bought for 1500. So he got a discount of 3%. So 15 3 is 45. So discount allowed is 45 and rest is paid. The rest is paid. Rest is 145. So what date is it? It is on 10. 10. So again it is so cash it has to come. Cash column it has to come. So this one. And who has paid? Ken has paid. Ken. How much? 4. Okay, then discount allowed. Where will discount allowed come? Discount allowed is the loss. So it will come this side. Ken. So what is the amount? 45. 45. And what is the date? It will come. It will come. Next. Brian paid Ken for the goods he had bought on 2nd April. So, debit Ken with cash and discount receipt. Debit Ken with cash and discount receipt. Debit Ken with cash and discount receipt. Debit Ken with cash, discount date? What date? So 12th. It's on 12th. So now, what is the amount? The amount is for the goods you bought, let's say cash discount on 2nd April. 2nd April you bought for 400 minus 5%, 20. Discount received is 20. Balance is cash. Discount received is 20. Balance is cash. This is how it is. So these are the books of brand. This is how you have to record. Similarly, so now you can see how it looks. So you can just note it down, or you can just have a look. So discount received ledger is also there. Discount received ledger is also there. Cash also is there. So here we have to complete the entry, right? So April 12. So Ken. Complete the double entry. Always complete the double entry. Discount received. So date is same. Amount is also same. Okay, so I would like to mention that all these things are very simple, but very basic and very important. Unless these concepts are clear, going ahead you will get confused in a lot of other concepts. Lot of students they ignore these topics. They take it for granted, like it is just easy and we have understood something like that. But afterwards, they will get some concepts wrong. So teachers are not tools to teach you unnecessary things, redundant things. They are teaching with a purpose. The books are not written just to fill up the pages, but with a purpose. So please follow it strictly, do it sincerely, study sincerely. So now, books of Ken, I will leave it to you. If you want me to do even that part, please make a comment in the comment section of the video. I will do it. Otherwise, I am not going to do that. It is assumed that you have understood everything. So till then, bye bye. Have a good day. Hey, remember, I'm a trainer, not a tutor. I train you to pass, to succeed, to clear your exams, to get better marks, to excel in your studies, so that you understand and do better and best, the best. It's 2K. I've been taking on classes. I'm aware of difficulties faced by various students, below average, above average. I analyze and understand what they don't really understand and how the students suffer. I feel the person, try to understand their difficulties, making the student understand the subject and making interesting for them to learn so that they excel in their studies is my core perspective. These days, a lot of students have various difficulties. They won't understand anything in the class. A lot of students who are pursuing online classes. A lot of students who are taken up distance learning classes face various difficulties in understanding the core concepts. So they try to understand, but most of the teachers have different methodologies to explain, and few students are unable to understand. It's a hard time for the students. Myself, not being just learned, but having understood the subject as a common sense. I'm a professional tutor, professional trainer, and educator, having on-job experience and theoretical knowledge in various subjects, such as direct taxes, indirect taxes, accounting, be it financial accounting, advanced financial accounting, cost accounting, advanced cost accounting, managerial accounting, advanced managerial accounting, management accounting, advanced management accounting, financial management, operations research, quantitative techniques, business mathematics, business statistics, business economics, business studies, and various other business management subjects. I even have on-hand experience in ERP, SAP, Tally, QuickBooks, and all. So I am in a better position to explain the real logistical issues, the logistical problems, the core concepts in a better way. So a lot of students approach me near the exams for exam-oriented crash courses and exam-oriented coaching so that they pass their exams. I have a record 100% of my students clear my exams, clear their exams with ease. 100% they succeed. So I explain them as if they are novice, ignorant novice. Even the ignorant novice understands the subject easily. So I teach them as a common sense, because any subject is more a common sense than a subject. So a student should be capable of understanding the concepts so as to make their life easier. So learning becomes pleasure and enjoy. So anyone who is interested, who wants to clear their exams with ease, without any difficulties, may please get in touch with me. I am available anytime for them. 24/7, I am available for them. Thank you. Caring is caring. So please subscribe, share to my channel, because spreading knowledge only increases your knowledge. Dear friends, welcome to Shasha's virtual classroom. So today we will look at problems from books of tribe and rule. So in this lesson we will learn how we record books of prime entry, how to prepare books of prime entry. So this is a problem from David Hopkins. So Mrugathait had the following transactions all on trade in March. So purchase goods from Ticolo for $10,000 less trade discount of 20%. Ticolo allowed him 5% cash discount. Sold goods from Snyman for $1,200 less trade discount of 10%. He allowed Snyman 4% cash discount. Purchase goods from Walters rupees 8,000 less trade discount of 10%. Walters allowed Mrugathait 5% cash discount. Sold goods to Car for $10,000 less trade discount of 10%. He allowed 4% cash discount. Snyman returned goods which had cost him $200. Returned goods which had cost $400 to Ticolo. Purchase goods from Burger for 7,000 less trade discount of 25%. Burger allowed him cash discount of 4%. Sold goods to Kodzak for $3,000 less trade discount of 10%. He allowed Kodzak 5% cash discount. Purchase goods from Ticolo for $6,000 less trade discount of 20%. Ticolo allowed him 5% cash discount. Cargill returned goods which had cost him $300. Returned to Burger goods which had cost $1,000. Sold goods to Snyman for $1,800 less trade discount of 10%. Mrugathait allowed Snyman 5% cash discount. Received checks from Snyman, Garg and Coates respectively in settlement of their accounts. So accounts receivable are 3 and send checks principal settlement of their account to Ticolo, Walters and Burger. So then enter the transactions from March in Mrugathait books of prime entry and post them in good form to the proper account. The transactions should be dated, however, for the purpose of activity. Ignore the dates and post the transactions to the correct books, the correct journal, and the correct ledger accounts. So we should record this in the books of prime entry. So where should we record this? So what are the books of prime entry? Purchase goods, purchase register. Sold goods, sales register. Purchase goods, purchase register. Sold goods, we have to record in sales register. Snyman returned goods. Snyman, who is Snyman? Obviously customer. So sales return. Return goods which had cost to Ticolo. So return goods to Ticolo, purchase return. Purchase goods from this is purchases goods. Purchase register. Sold goods to Kodzak, sales register. Purchase goods from Ticolo, purchase register. Car return goods which had cost him 300. Car return. Who is car? Car is there, so obviously it will be customer only. So sales return. Return to Burger. So purchase return. Sold goods to Snyman, sales register. So received checks from Snyman, Carg and Kodzak. So we have to record in type for the payments and for the amount received and for the amount we have paid. So now we have to record it. So how do we record it? The first entry. So we'll record entry wise. So first entry, purchase goods from Ticolo for 10,000 less trade discount of 20%. Discount. So we never record trade discount. We have to record the transaction at net amount. So that is at 80,000. So 10,000 20% is 2,000. 10,000 minus 2,000 is 8,000. 8,000 we recorded in purchase register. So purchase register Ticolo 8,000. Purchase register Ticolo 8,000. Okay. So similarly, next, sold goods to Snyman for 1,200 less trade discount of 10%. So sold goods to Snyman. So we have to enter in sales register. So 1,200 trade discount of 10%. So sales register Snyman. So date particulars, it is Snyman. Snyman, sold goods to Snyman for 1,200 less than trade discount of 10%. 1080. So we have to record like this. So everything we have to record in each and every book respectively. So sales register will look like this. So Snyman 1080, Carg 2250, Hertz at 2700, Snyman 1620. So you can see. So it is Snyman sold goods to Carg, sold goods to Kodze, sold goods to Snyman again. So 4 sales entries are there. So we have to record it in this particular style we have to record. So this is known as format or whatever. So we have to record in this particular way. So the transaction should be recorded in this particular format. So format is important. So then the next one we have to record in purchases. So we have done purchase one entry. So purchases will look like this. So we have purchased from Ticolo, Walters, Burger, and again from Ticolo 4800. So we have to enter in purchase journal like this. So take some time to write it down. Then we have to enter in sales return register also. So sales return register, what do we write? So whatever sales we have returned, all those entries. So what is it? Let us see what is the sales return. So Snyman return. Snyman we had sold to Simon. So Snyman return, which had cost him 200. Snow 200. So Snyman 200. So like this, similarly, we have to record all the sales returns. Snyman return, Carg also return. So Snyman and Carg we have to enter. So the entries will look like this: Snyman 200, Carg 200, 300. So similarly, purchases also we have to record. Purchase returns also we have to record. So what are the purchase returns? Purchase returns are return goods which have cost 400 to Ticolo. 400 to Ticolo means obviously Ticolo has given 20% trade discount. So which had cost him 400 means that is the net discount before discount, which had cost $400 to Piccolo. So that is before discount. So we have to take after discount and we have to record it after discount. So returns, purchase returns we have to record after discount. So it's not 400, so it is $320 and burger is 1000. So we have to record it net of discount. So we have to record in sales register, sales journal, purchase journal, sales return journal, purchase return journal. So we have to record in all these journals. Then ultimately we have to record in cash book for the payments made and received. So what are the payments that are made? So after doing all these entries we have passed. Purchase goods. So purchase goods from Ticolo we have passed. All these entries have been made. All these entries have been passed. So now last entry, receipt from check. Receipt checks. So we have to consider the discount also. The discount part, everything we have to consider. So let us make the working. So here it is. So Simon, we have sold to Simon worth this one. These are the returns. Total again we had purchased, again we had sold worth this one. So total amount is 2500. So totally 2500. He has given a discount of, we have allowed him discount of 5%. So the discount amount is 125. So the net amount 2375 we will be receiving from him. So I made all the amounts, list of amounts. So these are all sales or purchases. So these are all sales. This is also sale. These are all sales returns. These are all purchases. These are all purchase returns. These are purchases. These are the cash discount. This is cash discount. This is cash discount. So this is percentage of cash discount and this is amount of cash discount. So the net amount ultimately received or paid is coming here. So we have to do like this. So first we calculate. So this is the amount, net amount. These are the amounts that are received and these are the amounts that are discount. So we have to write it. So where do we write? So all these three guys have paid. Three guys have paid. So how much they have paid and what is the discount? We have allowed them a discount. This is the discount we have allowed. This is the amount we have received. So all these amounts we have received. And we have paid these three people. These three people we have paid. and we have got discount. These are the discount values. If we calculate, so ultimately the payment, the amount we have paid, so this is how the cash book will look like. The amounts we have received from accounts receivable, the discount we have allowed, the cash we have received, the discount we have received, the cash we have paid. So this is what is cash book, and cash book will look like this. So this we have to record, and that is also done. So now what all we did? So we entered, we recorded, we prepared sales register, we prepared sales register, we prepared purchase journal, we prepared sales journal or sales register, sales journal we prepared, we prepared purchase journal, we prepared sales return journal, we prepared purchase return journal, and we have prepared cash book also. We have prepared cash book. So now what is left? So now we have to prepare ledger accounts. So what are the ledger accounts? We have to prepare all the ledger accounts of all the parties. So sales account. Sales account is always a credit balance. So we are not supposed to record each and every entry. We have to record the total. We have to record the total in sales account. So sales account we have to record the total. So first let us do the total.
Hello. Yes.
So this is the total of sales, total of purchases,
Okay, from where are you calling, madam?
total of purchases, sales returns.
Hello. So you are looking for online or offline? So this one.
Sales returns, purchase returns, sales returns. So how do we record? So they come to ledger. So sales always is a credit balance by sales journal.
Okay, let me take a direct lesson. So let us see, because my one I'm taking.
We have to record here. So how much is it?
Let us see how the class goes. Then let us decide how whether the class is good
have to record this here. So then sales return. Sales return is reverse of sales to sales journal. So sales return journal.
Similar to how I take online, yeah, online or after. So today we can have a file.
Purchases account. Purchases is always debit. So to purchases journal. So total amount, purchases journal. This is the total amount we have to record here. So remember, we should never have to record individual entries in purchases account. So we have to record the total. Then purchase return. Purchase return is reverse. So journal, purchase return journal. So we have to record like this. Now we have to record entries related to Piccolo. So how do we record entries related to Piccolo? So who is Piccolo? Piccolo is a customer. Piccolo is a supplier, his accounts payable. So we have to credit him. So purchase. Purchase we have to record. Piccolo. So how much? Piccolo 8,000, 4,800. So purchase return is also there. What is purchase return? Purchase return is day 20. Purchase return is $320. So purchase return is $320. So then we have paid. So we have got some discount. Discount received is $624. So amount we have paid. Amount we have paid is cash. How much we have paid? So you can see the cash bill. 11856. So we have to see here and then you so 11856. Now let us just check. So now if we add all this, so that will be okay. So finally we have paid everything. So this is how the each and every account will look like. So we have to do the posting. So then accordingly we have to prepare all the ledger accounts. So now we'll prepare ledger accounts. So we have to see the transactions and then accordingly we have to prepare. So Ticolo we have purchased. We have purchased from Ticolo and there was purchase return of 320 and we have received a discount and ultimately we have paid. So this is how we have to record, seeing the debit side, credit side very carefully. Then Ticolo's account is over. Now we have to prepare Snyman's account. So Snyman is a customer. We have sold goods to him. So we have sold. We have returned also. So we have received. We have allowed a discount, and we have paid. So what are the amounts? Sales return. So the discount allowed, cash. So Snyman's account is also done. So now Walter's account. Walter is a supplier, is a accounts payable. We have purchased from him. So these are the purchases. We have received discount and we have paid cash also. So the discount we have received is 360 and cash we have paid is 6,840. So we can see from the cash book. Then again Burger also we have purchased from Burger. So 5,000 to 250. So there are purchase returns as well. So we have paid cash to Burger. So what is the discount? Is there no discount? There is a discount, so we'll just see. Then let us first finish this. So remember Burger account, there is we have to record purchases. So then cards, card. So we have sold goods to card. So we have to enter sales. We have to prepare card account. We have even made the sales return to him. So we are allowed in discount. So we have to record that. And we have paid. We have received cash. So even that we have to record. Then Hoyt's account. He is a customer. We have sold him. So 2,700, and we have allowed some discount, and we have received the balance amount from him. So done. So what is left? Burger account. We didn't give discount. Let us check whether we give discount. We received discount from Burger or no. Burger, yes, 170. We paid him 4,080. Burger, we received discount of 170. We received discount of 170. Still 170. So cash we have paid. So this is the amount of cash we have paid to Burger. Then which account is left? We have to prepare discount allowed and discount received. We have to enter discount allowed and discount received. So discount allowed from whom all we have received. So let us see. Discount allowed. We have allowed discount to these three people. Receivables. We allow discount to account receivables only, right? So we allow discount to receivables only. So we allow discount to these three people. And discount allowed is always a loss expense. And what is the amount? Amount also we can just note down from here. What is the amount? These are the amounts. These are the discounts that we have allowed. So, and we have received discount from accounts payable. We have received discount. So we have to record here. So which is an income. So we will credit it. So who are the payables? Who are the accounts payables? These three are accounts payable: Ticolo, Walter, and Berger. Ticolo, Walter, and Berger. We are accounts payables. So we have received discount from them. So the amount is this. So the amount is this, and this. Okay. So this is how we have to see the chapter is very simple, that unless otherwise you do all these things, unless you do all these steps, your understanding will not be clear. Your understanding of the subject will not be clear, and ultimately will get stuck in accounts receivables, accounts payables, even the advanced entries, whatever are required. At that time you will get stuck. So they look very simple, so at least 1 or 2 problems you have to do. So kindly ensure that you do this problem without fail. So then this is done. So what I do is I will give this problem as assignment to you. So this is also from David Hopkins. So you can just try this problem on your own. So then, if you have any doubt, you can let me know in the comments. I will help you work out. I think you can do it on your own. So I am 100% sure. So please try and finish it. So we can move on to the next lesson. So this is very simple. So 1 or 2 problems are more than sufficient. So if you want, you can do this. So if you let me know as a comment in the comment section, I will definitely do it. Otherwise, I will assume that you have understood and it's very simple. So we'll move on to the next lesson. So next lesson is how to balance the accounts. How to balance the accounts, that is what we are going to learn in the next lesson. So till then, bye bye. Dear friends, so we'll continue with books of primentary. So this is another column which is there in David Hopkins. So prepare journal entries with suitable narratives to record the following. So prepare journal entries only to ledger accounts, never to other books of prime entry. See here, journal entries with suitable narratives to prepare journal entries only to ledger accounts, never to other books of prime entry. Received from Mumtaz, invoice number 506, dated 3rd March 10,000. This was in respect of the purchase on a machine on credit. So this is the purchase of machine on credit. Okay, so it is purchase of machine. Machine is an asset. So it is not purchases. So it will not be recorded in purchases account because it is not purchase of merchandise. So it will be recorded in journal. So the entry will be recorded as machine account debit 2 Mumtaz. Why? Because we are purchasing from Mumtaz. Okay, we are purchasing machine from Mumtaz. So the entry will be machine account debit to Mumtaz account. On debit to Mumtaz account credit. So the amount will be, so what is the date? Date they are not mentioned. So they have mentioned just A. Okay, invoice number 506, purchase of machine on credit. What is the amount? Amount is 10,000. $10,000. 10,000. So you have to write the narrations. June, machinery purchased on credit, void invoice number 506. That's all. So we have to record it. So it will not go to purchase account. So no subsidy. Books of primary entry, book of primary entry. So we have to record it in journal. Journal proper. So next. Invoice number 495 dated 6th March. Sold to Wayne. Goods sold to Wayne. The invoice has been entered twice in the sales journal. So has been entered twice, has already been entered, but it is entered twice. So we have to pass rectification entry. So what is the entry when we make the sale? When we make the sale, the entry will be Wayne to sales. So now you have to reverse the entry. Wayne to sales. Now it will be sales account to Wayne's account. So the amount is 675. Sales recorded twice. Now reversed and rectified. So this is also done. Next entry. So then we'll see what is the next entry. Invoice number 998 dated 7th March for 4,250 in respect of delivery van purchased on credit from Yunus and paid by check. So delivery van purchased on credit from Yunus. Delivery van purchased on credit from Yunus. So 40 to 50, 4,250. 4,250. But you see, what is the entry? What is the question? Invoice number 998 dated 7 March 4,000 respect of delivery and purchase on rate
Hello.
from Yunus and paid for by check. So there is a check
Hello.
payment also, but we should never record check payment because check payment will be recorded in cash book. So only first part, which is purchase on credit from Yunus, only that will be recorded.
Hello.
So remember, if you write payment entry, then it is wrong, grave error. So never do. Okay. So accordingly, you have to be very careful when writing the entries. So all these entries, which never come in any of the other books, will always come in journal proper or general journal. So this is general journal where we are recording, because none of these entries are capable of being recorded in any of the prime, neither in the sales book nor in purchases book, neither sales return nor in purchase return nor in cash book. So other than that, whatever is there, that should be recorded in journal proper. So next, credit note number 103 dated 10th March 1 for $190 sent to Brownie but omitted from the sales return journal. So you have given credit note but you have not recorded in sales return journal. Now you record it, that's all. So sales return journal, so how do you record it? So what will be the entry? The entry will be, you have to write down in sales return journal, and then the next step is you have to write down the journal entry, that is you have to record the entry. So how do you record? Sales returns account debit to Brownie account credit. So you have to credit Brownie. Sales return account debit account debit to Brownie account credit. What is the amount? 190? Yes, 190. So you can write the entry full narration. So 190. So it's narrative. So you can write down full narrative. Sales returns now recorded. Sales returns now recorded. Sales returns now recorded. Next. Invoice number 854 dated 15th March 1300 for goods purchased from Sandra. The invoice has been posted to Geeta's account in error. So what has happened? It has been posted to Geeta's account. It is entered in purchases account, but the posting has been done wrong. The posting is wrong. So instead of posting to Sandra, the posting has been made to Geeta. So it is purchased from Sandra. So So you should have credited Sandra. Instead of crediting Sandra, you have credited Geeta. So what you have to do? You have to credit Sandra and debit Geeta. So the entry will be Sandra account debit to Geeta account debit. So the entry will be Geeta account debit to Sandra's account credit. Geeta account debit. Account. Amount wrongly credited to Sandra. Credited to Geeta. No rectified. So now rectified. So this is how you have to pass the rectification entries. So here you can write. See, it should be in debit column. This should be in credit column. Machine account debit, Mumtaz account credit, sales account debit, Ryan's account credit, delivery van account debit, Yunus account credit, sales returns account debit, Ravni account credit, Geeta's account debit, Sandra's account credit. What is the amount? So the amount is 1300. Amount is 1300. So all these are rectification entries. So if you observe, all these are rectification entries. None of these entries will come neither of the books of prime entry, neither in sales register, sales this one journal, nor in purchase journal, nor in sales return journal, nor in purchase return journal, nor in cash book. Neither of the books that will come in the residual book, that is journal co-op. So carefully you have to do this. So this is how we have to record. So this very important aspect. So entire chapter is based on this suspense account, rectification, suspense account. Lot of questions are asked in AS level. IGCSE also a lot of questions have been asked. So you have to be very thorough in this aspect. Debit and credit aspect, you have to be very thorough. So we will catch up in the next class. Till then, bye. Dear friends, these are exam practice questions from books of prime entry. So this is again from David Hopkins. So let us discuss this. So exam practice questions. So this is basically number 1. Tanya purchased goods for 1000 less 25% trade discount. So trade discount is never recorded but should be considered. So that is 1000 minus 25% is 250. She was allowed a cash discount of 10%. So cash discount will be considered at the time of payment. So entry will also be passed. What amount should she enter in her purchase journal? Purchase journal she has to record 750. So discount is never recorded at the time of purchase entry. Trade discount is recorded. Trade discount is recorded, but cash discount is not recorded at the time of in the purchase journal. It is not recorded in purchase journal. Next, Lara purchased goods costing 1800 less trade discount of 30%. So 1800 minus 30%. So that is equal to 1800 minus 30%. 1260, 1260. So that is 1260. Okay, so she was allowed a cash discount of 5%. She was allowed a cash discount of 5% means she has to pay less. So how much she has to pay less? She has to pay 63 less 5%, no? 5% of this. So 63 less. So this one. This should be, how much should Lara have to pay for the goods? It is 1197. So when we subtract this and this, it is 1197. So this one done. Next. See, these are exam style questions. So similar questions have been asked in the AS level examinations. So these are not A level questions, but AS level. So but IGCSE also they have been asked several times. So then coming to this, Cora sent an invoice to Maria for 2000 less 20% trade discount. So Cora sent an invoice to Maria for 2000 less 20% trade discount. So okay, so 20,000, 2000 less 20% trade discount is 2004, 1600. So 1600. So trade discount will be considered, but never recorded. So we have to take the net amount. So 1600, it should be recorded at 1600. Cora has omitted to enter. She has omitted. So Cora has omitted. So has sent an invoice means she has sold. To enter in a sales journal. She has not entered in the sales journal. So obviously what will happen? Sales account will be understated by 1600, not 2000, because the trade discount will be recorded. So even Maria's account also will be understated by 1600. The answer is, so then come this one. Shivam has received a check of $1540 from Raju in full settlement of a debt of 1700. How should this be recorded in Shivan's account? So what has happened? Shivam has received a check. So he has received a check of 1540 from Raju in full settlement of 1700. So there is a discount factor. There is a discount factor of 1700 minus 1540 is 160. So this should be recorded. Discount allowed should be recorded, and it should be recorded. How should this be recorded in June? So nowhere this should be recorded. Bank account, this should be recorded, and this should be recorded. We have to consider as if we have received full money from this guy. So the entry will be this one. This one will be the entry. So accordingly, the debit and credit aspect should be very, very clear. So practice these questions again and again. Often more and more questions we have to practice. So maybe a lot of MCQs we can discuss in the meantime, but before that, let us go through the entire syllabus so that the concepts are clear. Otherwise, just by solving the question papers or just by working out the question papers near the exam is not sufficient. Remember, slow and steady wins the race. So never ever think of shortcuts. Never resort to shortcuts. Start studying from day one. So start studying from the day one. So let's catch up in the next class. Basically, the next class is how to balance the account. Then, bye-bye. Dear friends, Welcome back to Shasha's virtual classroom. So this is balancing of accounts. Balancing accounts. So this is a question from David Hopkins. So basically, it's a very small question. So, but in this lesson, we'll learn how to balance an account. So balancing is nothing but totaling up all the values and then finding the difference and putting it on the right place. So that is what is balancing account. So this is the last step before preparation of trial balance. After this, we will be preparing trial balance. So before that, you should know how to balance the ledger accounts, because trial balance is prepared on the basis of balances of ledger balance, balances of ledger. So in this question, this is a small question. So first, let us make a list of debits and credits, so that our writing ledger entries will become easier. So let's classify and write which account will be debited, which account will be credited in each case. So paid into savings, paid is savings into business bank account 10,000. So bank account, money is coming in bank account and capital. So bought goods for resale on credit from Joe. Bought goods, so purchases on Joe. Paid rent of a shop by check, rent, yeah. Sold goods to Barney on credit, sales, Barney, sales. Made cash sales of goods, the money was used to set up cash flow. Made cash sales of goods, cash sales. Return faulty goods to Joe, returns. So returns to Joe. Joe paid by check for the goods he had bought after deducting a cash discount. So Joe has paid means paid Joe by check. So we have paid to Joe and we will receive a cash discount. So this is discount received. So then by check means obviously it's bank. Then paid for postage by cash. So postage, cash. So now we have to prepare all these accounts: bank account, capital account, purchases account, Joe account. So ledger accounts, prepare necessary ledger accounts. 3-column cash book. 3-column cash book. Record the transaction. So most of the entries will come in cash book also. So and some entries will come in ledger account. So then balance the accounts at 31st March and bring down the balances. So we have to balance also. So then what we'll do? So we'll start preparing all the accounts one by one. Okay, so capital account, purchases account, Joe account, rent account, Barney account, postage account, sales account, purchase returns account, and discount received account. So all these accounts we have to open. So now, what is the first entry? Paid his savings into business bank account, 10,000. So that is on March 1st. So March 1st, bank account should be debited with capital, and capital account should be credited with bank account 10,000. March 1st. Capital account should be debited with bank 10,000. 10,000. So then credited, capital account will be credited. So capital account will be credited on March 1st. March 1st. So bank account $10,000. Then first entry is completed. Bought goods for resale on credit from Joe. Bought goods for resale on credit from Joe. So that is on March 2nd. Purchases to Joe. March 2nd. Purchases purchases account will be debited with Joe. Joe account. And Joe's account should be credited. So purchases. So what is the amount? Amount is 4,000. Then, what is the next entry? Paid rent of shop by check. Paid rent of shop by check on the same day. Paid rent of shop by check. So March 2nd. Rent account. So March 2nd. By check means bank account. What is the amount? The amount is 1,000. the entry is complete. So now come to the next. Sold goods to Barney on credit. Sold goods to Barney on credit. So, sold goods to Barney on credit. Okay, sold goods to Barney on credit. Means Barney what date? So it's on 3rd March. On 3rd March. Third March. So you know why it is debited, why it is credited, right? So this all these aspects are clearly explained in chapter 1 and chapter 2. So if you have any doubts, you can just revert back to chapter 1 and 2 to see which accounts will be debited and why and all the things, so that the concept is clear. So don't presume with half knowledge. Don't try to do the problem. So be sure, 100% sure before passing the entries. So don't commit any mistakes, so that the concepts are clear. So if the concepts are not clear now, then everything will go wrong. So the amount is 2000. So everything will go wrong. So be careful. Then, so the entry is complete. Sales entry is also complete. Made cash sales of goods. The money was used to set up cash store. So you are receiving cash on selling of goods, cash sales. So cash sales are happening. So sales are always sales, whether they are cash sales or credit sales, or if you want, you can write it separately, credit sales and cash sales separately. So since this is a simple problem, it's okay. You can write both merged together. So cash you are receiving. How much you are receiving cash? It is $550. So 550 you are receiving cash. So when is it? It is on 3rd March. 3rd March. So March 3rd. So cash. So or otherwise you can write sales also. It's not an issue. It is not wrong to write sales. And in cash column you write. So what is the meaning of cash code? To keep it handy. To keep it handy. Cash to keep it handy. They have sold some goods and they have kept money. So sales, the same date, cash account 550. Okay, now coming to the next part. Returned faulty goods to Joe. Returned faulty goods to Joe means from Joe we had purchased, now we are returning. So it is purchase returns 200. 5th. On 5th there is purchase returns. On 5th there is purchase returns to Joe. How much? 200. 200. Don't forget to mention the currency. So to whom we have written? Joe we have written. Where is Joe's account? Joe's account is here. So March 5th. What is the value? 200. 200. 200. 200. So the entry is complete. So now come to paid Joe by check the goods we had bought after deducting 5% cash discount. So cash discount. So we have to calculate how much you are paying. So 4,000 is the purchase and 200 is the return. So 3,800 you have to pay. 5% cash discount you have to deduct and pay. 3,800 minus 5%. 3,800 minus 5% you have to deduct and pay. $190 is the discount. 190 is the discount. 190 is the discount. So you are paying Joe. Tom. So 190 is the discount. How much you are paying? 3610. 3610 you are paying. So when you are paying this, you are paying this on 7th. So you are paying this on 7th. 7th. So you are paying this on March 7th. What is the amount of rent you have paid? Rent you have paid 1,000. Okay. Rent you have paid 1,000 and you paid it by check. So this is also done. Now cash discount. Paid for postage by cash 20. Paid for postage by cash 20. So paid for postage by cash what date? 7th itself. Postage account. By cash 20. So postage account you have to enter in postage account also. So you have to enter in postage account also. Cash 7th March. March 7th. So dollars. Joe, you have paid, right? Where is the entry related to Joe's spending? You have paid to Joe. How much you have paid to Joe? We have received cash discount received also. Discount received and we have paid money to bank account. So bank account is 3610. $190 is the discount received. So discount received also should be entered. Discount received is again. So Joe has account. So 190. So the entries are over. So all the entries have been made. So please cross check whether all the entries have been done. So you can cross check, I am sure, but you also cross check. Then now prepare the necessary ledger accounts and 3-column cash book. So we have prepared 3-column cash book. Balance the accounts at 7th March and bring down the balances. Now we have to balance and bring down the balances. Now this part is remaining. So we have to learn how to balance the accounts. So this we are going to learn. This is the main thing we will be learning in this lesson. So come to cash book. So cash book, what we have to do, has everything been entered in cash book? Cross check once if everything has been entered. So then what you have to do, you total it up. So you total it up like this. So when you total it up, obviously okay. So you see, in the cash column there is a total of 550 on the debit side. Bank column there is a total of 10,000 on the debit side. Discount column there is nil. Here discount column there is 190. Cash column 20 is in credit side. Bank column there is 4610. So how we have to balance is, this side is heavier, this side is heavier, this side is heavier. So this minus this side minus this side, this minus this. So basically, balance, carry down your right here. Balance, carry down your right. Then what you have to do? You have to find the difference of this value and this value. You have to find the difference of this value and this value. So whatever comes, that you have to write. So is equal to 10,000 minus 4610. So 5390. See, when you put this value, this both will become equal. So the total should be such that whatever amount you put, the total will be same. See, this should be same. So to find that, we have to put that balancing figure. This is the balancing figure. That's why it's called balance carry down. This is known as balance carry. Similarly, here it is 550. Here it is 20. So what you have to do here also 550 minus 20, 530. So that even this, both the total becomes 550. And what about discount column? No, never. Discount column should never be balanced because it is just, it is not part of double entry.